Hello friends, today's topic is case laws which is related to the provisions of the profit and gains from business or profession. Case laws will help you to interpret what the section, what the provisions of the profit and gains are trying to say. So the first case law is a Supreme Court case law of ICDS Limited 2013. The issue under consideration in this case was, can the depreciation on leased vehicles be denied to the lessor on the ground that the vehicles are registered in the name of the lessee and the lessor is not actually using the vehicle? So, in this case, the SSC is in the leasing business of the vehicles in which he acquires the vehicle and thereafter those vehicles are leased to the lessee, and as per the requirement of the Motor Vehicles Act, that particular vehicle is supposed to be registered in the name of the lessee and the lessee uses that particular vehicle for his business. So, for the purpose of claiming depreciation in the hands of lessor or in the hands of the owner, it is very much important that it is used by the owner, by the SSC, for the purpose of his business, plus the same should be, first condition is should be used for the purpose of the business, and secondly he should be the owner of the property, of the concerned property on which the depreciation is supposed to be claimed. So whether these conditions are being satisfied by the lessor or not, that needs to be interpreted for the purpose of deduction under section 32 for the purpose of claiming depreciation. Now, facts of the case: the SSC is a NBFC engaged, amongst other things, in the business of leasing and hire purchase. The SSC purchased vehicles directly from the manufacturers and as a part of its business leased out these vehicles to its customer. So as a part of his business, leasing is the part of the business of the SSC. Business of leasing and hire purchase is the business of the SSC. Lessees are registered as the owners of the vehicles, and at physical possession of the vehicles, the SSC lessor claimed depreciation on such vehicles. Assessing officer disallowed. Assessing officer disallowed the depreciation. According to the assessing officer, the SSC had merely financed the purchase of these assets and was neither the owner nor the user of these assets. So, as per the assessing officer, both the conditions of owning the property and using the assets, for the purpose of claiming of depreciation are not being satisfied by the lessor. Accordingly, depreciation is disallowed in his hands. High Court's observation and decision. High Court was also of the view that the SSC could not be treated as the owner of the vehicles, since the vehicles were not registered in the name of the SSC and the SSC had only financed the transaction. Therefore, the High Court held that the SSC was not entitled to claim the depreciation. So, High Court was of the opinion that lessee is only financing the asset, financing the vehicle, and he is not the owner of the vehicle. In absence of ownership, depreciation would not be allowed. So, High Court's decision: SSC was not entitled to claim depreciation. Supreme Court's observations. Supreme Court observed that Section 32 imposes a twin requirement of ownership and usage of business as conditions for claiming depreciation. So there is a twin requirement. of owning the property and usage for business. Supreme Court further observed that as far as usage of the asset is concerned, the section requires that the asset must be used in the course of the business. It does not mandate actual use by the SSC itself. This sentence is important. So, as far as the vehicle, the asset is used for the purpose of business, it will continue to be satisfying the condition of depreciation. Actual usage by the SSC himself is not required. In this case, the SSC did use the vehicles in the course of its leasing business. Hence, this requirement of Section 32 has been fulfilled, notwithstanding the fact that SSC was not the actual user of the vehicle. So, here the Supreme Court observed that the SSC had used the asset for the purpose of business because the business of the SSC was leasing out the property, leasing out the vehicle. So that's what the SSC has already done. It's only that it hasn't been used by the SSC itself. And there is nowhere mention in section 32 that it should be used by the SSC himself. If the asset is used for the purpose of business of the SSC, then one of the conditions of using the asset for the purpose of business is satisfied for claiming depreciation. So, Supreme Court is of the view that the first condition of usage of the property is being satisfied by the SSC. The Supreme Court further noted that Section 230 of the Motor Vehicles Act is a deeming provision which creates a legal fiction of ownership in favor of the lessee only for that act and not for the purpose of law in general. So, Motor Vehicles Act provides a legal fiction over here for ownership in favor of the lessee, and for the purpose of law in general, lessee can be termed as not to be owner of the vehicle. So the mandatory requirement as per the Motor Vehicles Act is only the legal fiction, provides only legal fiction to the lessee, but in generality, he is not the owner of the asset. Lessee is not the owner of the asset. Continuing, no inference could be drawn from the registration certificate as to ownership of the legal title of the vehicles. If the lessee was in fact the legal owner, he would have claimed depreciation on the vehicles, which was not the case. Supreme Court observed that as long as the SSC lessor has a right to retain the legal title, he would be the owner of the asset in the eyes of the law. In this regard, the following provisions of the lease agreement are noteworthy. So, following provisions of the lease agreement, which will state whether the SSC lessor is is indeed the owner of the asset or not. First, the SSC is the exclusive owner of the vehicle at all points of time. This is what is mentioned in the lease agreement. So, this is the lease agreement points. First point, SSC is the exclusive owner. It is mentioned in the agreement, which is coming out of the lease agreement between lessor and lessee. The SSC is empowered to repossess the vehicle in case the lessee committed a default. So, in case of any default by the lessee, there is a clause of repossessing the vehicle by the lessor. At the end of the lease period, the lessee was obliged to return the vehicle. So, the vehicle will come back to the lessor. The SSC had a right of inspection of the vehicle at any point of time. It can be seen that the proof of ownership lies in the lease agreement itself, which clearly points in favor of the SSC. So, as per the lease agreement, there are several clauses which states that the ownership remains with the lesser. So, any inference, any conclusion based on the mandatory requirement of Motor Vehicles Act will not affect the provisions of the lease agreement. Supreme Court held that SSC was entitled to claim depreciation in respect of vehicles leased out since it has satisfied both the requirements of Section 32, namely ownership and usage. Ownership is satisfied based on the provisions under the lease agreement, and the conditions of usage of the asset is already satisfied when when the vehicle was leased out to the lessee, and actual usage of the vehicle by the SSC himself, it's not necessary. So the Supreme Court held in favor of the SSC, wherein he is eligible to claim depreciation on the leased vehicles. Now, moving on to the next case law, Delhi High Court case law in the case of CIT versus K and Company 2014. Issue under consideration is the interest income on margin money deposited with bank for obtaining bank guarantee to carry on business taxable under the head PGBP or income from other sources. So the margin money which is supposed to be deposited with a bank on account of obtaining bank guarantee and interest thereon, whether the same is to be taxed as business or profession income or income from other sources. So, as a distinction, if any income which is related to the business of the SSC, any income which is related to the business of the SSC will be taxed as business and profession income, and if not, then the same will be taxable as income from other sources. So, if it can be derived, if it can be concluded that such interest income is related to the business of the SSC, if such interest income is indeed related to the business of the SSC, then the same will be taxed under PGPP. Facts of the case: the SSC running a lottery deposited certain funds with a bank in order to obtain bank guarantee. Such guarantee enabled the SSC to carry on the business of printing lottery tickets and for conducting lotteries on behalf of the government. So, you can see over here that this deposit was extremely necessary for the purpose of business of lottery of the SSC. Business of the SSC. The funds which were held as margin money earn some interest, and through this deposit there is an interest income, and this deposit is related to the business of the SSC. High Court's observations. High Court noted that the interest income from the deposits made by the SSC is inextricably linked to the business of the SSC. So it is linked to the business of the SSC, and such income therefore cannot be treated as income from other sources. The margin money requirement was an essential element for obtaining the bank guarantee. If the SSC had not furnished the bank guarantee, it would not have got the contract of running the said lottery. High Court's decision: interest income received on funds kept as margin money for obtaining the bank guarantee would be taxable under the head profit and gains from business or profession, and if there are any expenses incurred regarding the margin money, then the same will be allowed as deduction under the head PGPP. So, this case law was in favor of the SSC, wherein any interest on the margin money which is necessary for the purpose of business will be allowed will be taxable under the head PGBP, and expenses related thereto, for example, will be allowed under PGBP. Next case law, Supreme Court case law, Raj Dadarkar and Associates. The similar case law was also discussed while doing the income from house property, and it contains two heads. One, whether the income should be taxable as income from house property, or whether the income should be taxable as rental income should be taxable as income from business or profession. Therefore, we have to discuss this case law as well. This case law is relevant for income from business income also, income from business or profession also. 2017 case law issue under consideration whether rental income earned from letting out of premises is to be treated as business income or as income from house property. So it will solely depend on whether the business whether the business of the SSC is indeed letting out of the premises or not, letting out of the premises and earning rental income on the same, whether this is indeed the business of the SSC or not. If the SSC is able to prove through the object clause and through the conduct of the affairs of the company, then it will very well be allowed in the hands of the SSC. If not, then the same will be taxable as income from house property. Again, stressing on the need why such bifurcation is important is from the purpose of for the purpose of claiming deduction. If at all the income is taxable as business and profession income, then there will be associated expenses to it which will be allowed based on if it is solely related to the business, and the same will be allowed, and there is a possibility that there might be even a loss wherein the expenses are increasing when compared to the revenue of business and profession. Whereas if an income is taxable under the head income from house property, then the standard deduction of 30% is allowed irrespective of the actual expenses incurred. However, 70% income is subject to tax. And if there is no interest on the capital borrowed, for example, if there is no capital borrowed, there will be no interest, and accordingly, the deduction will be limited to only 30%. Vis-a-vis, in income from business or profession, the expenses could exceed 30%. That's why such bifurcation is all the more important. Now, the facts of the case. SSC had acquired the right to conduct a market on certain land from municipal corporation. The premises allotted to the appellant was a bare structure, and it was for the appellant to make the premises fit to be used as a market. The appellant spent substantial sums to construct 95 shops and 30 stalls. So this land, the piece of land, is borrowed from the municipal corporation Greater Mumbai by the SSC. Thereafter, the development of the land, the development of premises, the construction of premises on that particular land is the responsibility of the SSC, and the SSC has built up various shops and various stalls which he will rent it out for the purpose of earning rental income. SSC treated income from subletting of such shops and stalls as business income. The return of the SSC for assessment year 2000-2001 was reopened by the assessing officer by issuing notice under section 148. So assessing officer is disagreeing with the income being offered as business income. Supreme Court's observations. Supreme Court held that wherever there is an income for leasing out premises, it is to be treated as income from house property. However, it can be treated as business income if the letting out of premises itself is the business of the SSC. So, letting out of the premises, if it's the business of the SSC, then it will be considered as taxable as business and profession income. the question has to be decided based on the facts of each case, as held in Sultan Brothers Private Limited. So, relying on the case law, which says that there is no general rule for the taxability of a particular income as business or profession income or as income from house property, but it is to be decided based on the facts of the each case. As per Sultan Brothers Private Limited, in the given facts, analyzing the facts, SSC would be considered to be a deemed owner under Section 27(3)(b). Read with Section 269 UAF. This section states that if the leasing period is more than 12 years, then the lessee is termed to be as a deemed owner of the property, and accordingly the income from house property is to be calculated. The rental income from the house property will be calculated as income from house property. So in the given facts, SSC would be considered as deemed owner. The only evidence submitted for proving that the letting out and earning rents is the main business activity of the appellant was the object clause of the partnership deed. So, the only evidence submitted by the SSC was that the object clause of the partnership deed stated that the business of the SSC is letting out and earning rents. The Supreme Court held that the clause held that clause to be inconclusive and observed that the SSC had failed to produce sufficient material to show that its entire or substantial income was from letting out of the property. So here the SSC has failed to submit sufficient material on record. Only because in absence of the sufficient material, the only material submitted was object clause of the partnership deed, and any further materials weren't submitted by the SSC. Accordingly, Supreme Court concluded that in absence of sufficient material, that letting out of the property is the main business of the SSC. It can be termed as that the rental income is taxable under the head income from house property. Supreme Court held that in this case, income is to be assessed as income from house property and not as business income on account of lack of sufficient material to prove that the substantial income of the SSC was from letting out of the property. So, in absence of sufficient material, the said income will be subject to tax under the head income from house property. So, solely based on the facts of the case, it can be termed over here in this particular case that such income is income from house property. Accordingly, Supreme Court held the observation against the SSC, and the income should be taxed under the head income from house property as contended by the assessing officer. There are two case laws as well by the apex court himself, by the apex court itself, wherein it has been held in favor of the SSC, wherein the income from business of profession is the income of letting out of business. Letting out of business is the income from business of profession. Case laws in favor of the SSC. In Chennai Properties and Investments Limited 2015, Supreme Court observed that holding of properties and earning income by letting out of these properties is the main objective of the company. So based on the object clause, you can say, based on, since it's a company, based on memorandum of association, and based on the return of income, and based on the conduct of the affairs of the company, Supreme Court concluded that the main business is indeed the letting out of the property of the SSC. Further, in the return of income filed by the company and accepted by the assessing officer, the entire income of the company comprised of income from letting out of such properties. Supreme Court accordingly held that such income was taxable as business income. So, in this particular case, As stated in Sultan Brothers Private Limited, we have to go by facts of each case. In this case, sufficient material were provided. In the case of Chennai Properties and Investments Limited, sufficient materials were on record, and accordingly it was concluded that income from letting out of the property is taxable as business income. Likewise, in Rayala Corporation Private Limited, Supreme Court noted that the SSC was engaged only in the business of renting its properties and earning rental income thereof, and accordingly held that such income was taxable as business income. So there is a case law. There are two case laws that we have discussed which are in favor of Supreme Court, which are in favor of the SSC. The Supreme Court case law, two case laws are in favor of SSC, wherein it has been held based on sufficient material on record that the letting out of property is indeed a business income and it is supposed to be taxed as income from business or profession, vis-a-vis in absence of sufficient material. In the case of Raj Dadar Private Limited, Raj Dadarkar and Associates, in that case it was held that such income is supposed to be taxed as income from house property. Now friends, the next case law, which is a Delhi High Court case law in the case of CIT versus BSES Yamuna Powers Limited in 2013. The issue under consideration over here is rate of depreciation applicable in case of computer accessories or peripherals. What should be the rate of depreciation in the case of computer accessories? It could be either 15%, which is the general rate of plant or machinery, or do we take the rate as 40%, which is the rate applicable for computer or computer software. So this is the issue under consideration, whether the rate of depreciation should be 40% or 15%. If a point of argument in this case can be that if the accessory could be a printer, a server, and other accessories, mouse or keyboard you can say. So different computer accessories, whether these accessories form an integral part of the computer through which the accessory would not be able to operate. So if the accessories are integral part of the computer, it can be said that the rate of depreciation can be applied as 40%. On your screen, facts of the case, the SSC claimed depreciation on computer accessories and peripherals at the rate of 60% with effect from assessment year 1819. The rate of each and every asset which was more than 40% has been reduced to 40% as per Appendix 1 of Rule 5 of Income Tax Rules. Now, earlier, the rate of depreciation on computer was 60%. With effect from assessment year, the rate of depreciation has been changed to 40%. So, in this particular case law, you can see the case law is of 2013. At that point of time, the rate of depreciation on computer was 60%. Accordingly, you will find a reference as the rate applicable as 60%. But as per the new law, it should be understood that it is 40%. So the rate of depreciation applied by the SSC was 60%, being the eligible rate of depreciation on computers, including computer software. However, the revenue contended that computer accessories and peripherals cannot be treated at par with computers and computer software, and hence were eligible for depreciation at a general rate applicable to plant and machinery, which is 15%. Revenue is saying it should be 15%. However, the SSC is saying it is 60 or 40%. High Court's observation and decision. the High Court observed that computer accessories and peripherals such as printers, scanners, server, etc. form an integral part of the computer system. They are integral part of the computer system and they cannot be used without the computer. This sentence is important. Consequently, the High Court held that since they are part of the computer system, they would be eligible for depreciation at the higher rate of 60% or 40%, which is applicable to computers including computer software. So whatever rate is applicable to a computer will be applicable to computer accessories or peripherals, which in the example could be printers, scanners, server, etc. Whatever rate is applicable to computer is applicable to computer accessories. Accordingly, the rate of depreciation will be in the present law 40%. And the change in rate of depreciation that I was discussing with effect from assessment year 1819, CBDT has, by notification number so and so dated November 2016, notified that the applicable rate of normal depreciation for computers would be 40%, and hence the eligible rate of depreciation on computer accessories and peripherals or UPS, including UPS, would be 40%. So, High Court's decision was in favor of the SSC, wherein it was held that even computer accessories and peripherals are integral part of computer, without which they cannot be used. Accordingly, the rate of depreciation will be same as computer rate, which is 40%. There is a similar court ruling wherein the Delhi High Court, the same High Court, in the case of CIT versus Orient Ceramics Industries Limited 2013, following its own judgment in the above case, held that depreciation on UPS is allowable at the rate of 60%, now 40%, being the eligible rate of depreciation on computers including computer software, and not at the general rate of 15% applicable to the plant and machinery. So there is another case law in the case of Orient Ceramics and Industries Limited, in which the Delhi High Court held that depreciation on UPS, which is again a computer accessory, one of the computer accessory, depreciation on UPS will be 40%, which is same as computer, and not 15%, which is the general rate of plant and machinery. Now the next case law, Delhi High Court in the case of Areva T&D India Limited versus DCIT 2012. Issue under consideration is, can business contracts, business information, etc. acquired by the SSC as part of the slump sale and described as goodwill be classified as an intangible asset to be entitled to depreciation under section 32(1)(2). So whether goodwill, which is acquired in a slump sale by the SSC, be classified as an intangible asset and accordingly eligible for depreciation under section 32. So friends, while discussing section 32, there was a sort of definition for intangible assets, wherein depreciation will be available on so and so intangible assets. It included know-how, patents, licenses, franchises, etc., or any other business or commercial right. These were included under the definition of intangible assets, and accordingly a rate of 25% of depreciation was eligible. However, as per that definition of section 32, it doesn't include specifically goodwill in it. So there will be two views in it. You can say a sort of ambiguity in the provision, and accordingly, this litigation wherein there is no specific mention of goodwill under the definition of intangible asset under section 32. So there is an ambiguity whether goodwill should be depreciated, should be allowed to be depreciated in absence of specific mention under the definition, or it is to be included as any business or commercial right, and accordingly it's an intangible asset and eligible for depreciation. So there are two views over here. So revenue is contending in this case that goodwill is not an intangible asset because it is not specifically mentioned, and SSC is contending that it is nothing but any business or commercial right, and accordingly part of definition of intangible asset, and depreciation should be allowed on goodwill. So facts of the case. In the present case, a transferor under a transfer by way of slump sale transferred its ongoing business unit to the SSC company. An ongoing business unit was transferred to the SSC. On perusal of the sale consideration, it was found that some part of it was attributable to the tangible assets, and the balance payment was made by the SSC company for acquisition of various business and commercial rights. So apart from intangible assets, there was acquisition of various business or commercial rights categorized under the separate head, namely goodwill, in the books of accounts of the SSC. So such business or commercial rights were booked in the books of accounts as goodwill of the SSC in the SSC's books of accounts. This business and commercial rights comprise the following: business claims, business information, business records, contracts, skilled employees, and know-how. So the word goodwill includes all these assets which are intangible in nature, and there is no specific mention of this apart from know-how. There is no specific mention under the definition of intangible assets under section 32. The SSC company claimed depreciation under section 32 on the excess amount paid, which is the amount paid on goodwill, which was classified as goodwill under the category of intangible assets. Contention of both the parties. As we have discussed earlier, contention of the revenue is that the depreciation should not be allowed, and the contention of the SSC is that depreciation should be allowed because it is part of any business or commercial right as per the definition of intangible assets. The assessing officer accepted the allocation of the slump sale between tangible and intangible assets, which is described as goodwill. However, he claimed that depreciation in terms of section 32.1.3, 32.1.2 is not allowable on goodwill. He further contended that the SSC has failed to prove that such payment can be categorized under other business or commercial right of similar nature as mentioned in section 32.1.2 to qualify for depreciation. So the assessing officer is contending that SSC is not able to prove that goodwill will be part of business or any commercial right of similar nature. The SSC argued that any right which is obtained for carrying on the business effectively, any right which is obtained, which is acquired for carrying on the business effectively, is likely to come within the sweep of the meaning of intangible asset. Therefore, the present case shall qualify for claiming depreciation since business claims, business information, etc. are in the nature of business or commercial rights. So SSC is contending over here that any right which is acquired for carrying on the business effectively, any right acquired for carrying out the business effectively which helps in running the business further should be part of intangible asset as any business or commercial right of similar nature. However, the revenue argued that the business or commercial rights acquired by the SSC would not fall under the definition of intangible asset under Section 32. Now, High Court's observation. The Delhi High Court observed that principle of ejusdem generis provides, as per this principle, friends, the particular words which are used in a sentence when followed by general word, then the meaning of the general word will be borrowed from those particular words which are preceding to the general word. Meaning, as per the definition of intangible asset, know-how, patent, license, franchises, these are particular words, and thereafter it follows a general word which is any business or commercial right. This is a general word. So as per the principle of ejusdem generis, the general word, which is in our case any business or commercial right, that general word will borrow its meaning from particular words, that is know-how, patent, franchises, and licenses. Continuing, provides that where there are general words following particular and specific words, general word is following particular word, the meaning of the later word, the meaning of the general word shall be confined to the things of the same kind, meaning it will borrow its meaning from the particular words. The court applied this principle for interpreting the expression business or commercial rights of similar nature specified in section 32. It is seen that such rights need not be the same as description of know-how, patents, trademarks, licenses or franchises. High Court, High Court said that it is seen that such rights need not be the same as description of particular words but must be of similar nature as that of specified assets. So High Court held that the wording, the general word should be of a similar nature as that of the particular words. The use of these general words after the specified intangible assets clearly demonstrates that the legislature did not intend to provide for depreciation only in respect of specified intangible assets, but it intended that it applies to also to other categories of intangible assets, whether which were neither feasible nor possible to exhaustively enumerate. Meaning, the legislature intention by providing a general term at the end of the definition of section 32 of intangible assets, thereby it meant that it is an inclusive definition. It will not only include specific words but will also include general word which has been mentioned over there. And because the only thing was practically it was not feasible for the government, it was not feasible for the legislature to mention each and every example therein. That is why a general term has been provided under the definition of intangible assets under section 32. I will read this sentence again. The use of these general words after the specified intangible assets clearly demonstrates that the legislature did not intend to provide for depreciation only in respect of assets which have been mentioned, but also in respect of other categories of intangible assets which were neither feasible nor possible to exhaustively enumerate, which were neither feasible or nor possible to mention therein. Further, it was observed that the above mentioned intangible assets are invaluable assets which are required for carrying on the business acquired by the SSC without any interruption. So these intangible assets, business contracts, business information, know-how, skill employment, these assets were invaluable assets which were required by the SSC for carrying on the business without any interruption. So they are necessary for the conduct of the business. The aforesaid intangible assets are comparable to a license to carry on the existing business of the transferor, meaning it can be held synonymous to a license, obtaining a license, which is specifically mentioned under section 32 for the definition of intangible assets, wherein the word license qualifies under the definition of intangible asset. So the High Court observed that the aforesaid intangible assets are comparable to a license and accordingly held that the specified intangible assets acquired under the slum sale agreement by the SSC are in the nature of intangible asset under the category other business or commercial rights of similar nature specified in section 32(1)(2) and accordingly eligible for depreciation under section 32. So the goodwill acquired by the SSC will be eligible for depreciation. It will be included under the definition of intangible asset under the category of any other business or commercial right of similar nature. So in this case, Delhi High Court was in favor of SSC, held in favor of SSC, and the SSC was eligible to take depreciation on the goodwill amount paid under a slum sale agreement. Now friends, the next case law is a Supreme Court ruling in the case of CIT versus Smiths Securities Limited 2012. Issue under consideration is the SEC entitled to depreciation on the value of goodwill considering it as an asset within the meaning of explanation 3b to section 32(1). So it's a similar consideration, similar issue which we have discussed earlier, wherein whether goodwill should be considered a part of definition of intangible asset and accordingly depreciation will be allowed to the SSC under section 32(1) or not. Facts of the case: SSC has paid an excess consideration over the value of net assets. SSC has paid an excess consideration over the value of net assets of the amalgamating company acquired by it, which is treated as goodwill since the extra consideration was paid towards the reputation which the amalgamating company was enjoying in order to retain its existing clientele. So the payment is made for the reputation of the amalgamating company in order to retain its existing clientele. So here the payment has been made on account of scheme of amalgamation for the purpose of goodwill. The SSC had claimed depreciation on the said goodwill. However, assessing officer contended that goodwill is not falling under explanation 3 to section 32(1). Explanation 3 is nothing but the definition of intangible asset as per section 32 and therefore as per assessing officer goodwill is not allowed to be depreciated. Supreme Court's observation on this issue: the Supreme Court observed that explanation 3 to section 32(1) states that expression asset shall mean an intangible asset being know-how, patents, copyrights, trademarks, licenses, franchises, or any other business or commercial rights of similar nature. So again, the definition of intangible asset not only includes know-how, patents, copyrights, trademark, licenses, or franchises, but it also includes any other business or commercial right of a similar nature. Similar nature, in a way, the nature will be borrowed from the particular words which are preceding the general word. So, as per principle of existence generis that we have studied in the earlier case law, that we have discussed in earlier case law, any other business or commercial right will borrow its meaning from the particular words which are mentioned in intangible assets, and it is not necessary that goodwill or any other intangible asset should be specifically mentioned under the definition of section 32. If it's in the nature of any business or commercial right, meaning if any payment is done for which it is helping the existing business of the SSC, anyway it is adding value to the business of the SSC, then it can be termed as any business or commercial right of a similar nature, and accordingly it may be treated as intangible asset and taxable, and depreciation may be allowed under section 32 of the Income Tax Act. So the issue is quite similar as per the previous case law, wherein whether goodwill will be an intangible asset or not is the issue. Supreme Court's decision, a reading of the words any other business or commercial right of similar nature in explanation 3b indicates that the goodwill would fall under the said expression in the process of amalgamation, and the reason is mentioned in this para. In the process of amalgamation, the amalgamated company had acquired a capital right in the form of goodwill, because of which the market worth of the amalgamated company stood increased. So, the benefit of acquiring goodwill was the market worth of the amalgamated company increased. So, it helped the SSC in improving the business prospects. It is helping the acquisition of the asset is helping the business of the SSC. Only because of this reason, it can be termed as any other business or commercial right, and acquisition of any other business or commercial right will be termed as intangible asset, and accordingly depreciation will be available to the SSC. Therefore, it was held that goodwill is an asset under explanation 3b of section 32(1), and depreciation thereon is allowable under the said section. The Supreme Court held in favor of the SSC, wherein acquisition of goodwill in the scheme of amalgamation was considered as part of definition of intangible asset, and text as accordingly depreciation was allowable under section 32. Now friends, the next case law, it's Chennai High Court ruling in the case of Srimati A. Sivakami and another 2010 case law. The issue under consideration over here is, would beneficial ownership of assets suffice for claim of depreciation? Whether based on beneficial ownership of the SSC, can a depreciation can be claimed under section 32 or not, is the issue under consideration. So here the difference between legal ownership and beneficial ownership. These two concepts have always been litigative under the income tax law, wherein depreciation is always allowed to a beneficial owner and not to legal owner. So I will give an example wherein the difference between the beneficial and legal ownership will be differentiated. First, let's say the SSC is into business of leasing out the motor car, wherein they purchase the motor car and lease it out for their business or profession, and they earn rental income on the same. In these cases, what happens is the owner or the lessee has to register the motor car in their name in order to use the motor car as per Motor Vehicles Act. So, the owner, the original owner who has leased out the asset, the lessor, that is the owner, the lessor is not the registered owner, lessee is the registered owner. However, there are terms in the agreement wherein if if regular lease payments are not made by the lessee to the lessor, then the asset is supposed to be confiscated by the lessor. And the asset, that is the motor car, will go to the lessor. So, if in case of such a terms of agreement, the ultimate owner, the beneficial owner of the asset, will continue to be lessor, the registered owner only as per the Motor Vehicles Act, which is the requirement of the Motor Vehicles Act. The lessee will be termed as registered owner or legal owner. However, lessor will be termed as beneficial owner because he has the right towards the property in case lease rentals are not paid, in case there is damage or defect to the motor car, then the risk is with the lessor. So the beneficial owner will continue to be lessor, and accordingly he will be the owner. The lessor will be the owner of the property for the purpose of Income Tax Act as well. So coming back to the issue under consideration, whether depreciation benefit is available to beneficial owner or legal owner. So one of the basic condition under depreciation for claiming depreciation under section 32 is the assessee should be the owner of the asset. Now this term owner is whether a beneficial owner or legal owner. This owner, the term owner, is nothing but the beneficial owner, and the claim for depreciation can only be made by the beneficial owner of the asset. Coming to the facts of this particular case, the assessee running a proprietary concern claimed depreciation on 3 buses even though she was not the registered owner of the same. The assessee has claimed depreciation on 3 buses even though she is not the registered owner. However, in order to establish that she was the beneficial owner, she furnished documents relating to loans obtained for the purchase of buses, repayment of such loans, which was out of collections from the buses, road tax, and insurance paid by her. So over here, SSC, which is running a proprietary concern, has purchased buses which are on loan. So in support of the claim of beneficial ownership, she is not the registered owner. However, she is claiming that she is a beneficial owner of 3 buses and accordingly claiming depreciation. In support of her claim, she has furnished documents wherein loan related documents are furnished, wherein the repayment schedule has also been mentioned. Also, the insurance that she is paying on the asset is also submitted. The documents related to it are also submitted to the court of law. She had also obtained an undertaking from the person, from the lessee, who hold the legal title of the vehicles as well as permits for plying buses in the name of her proprietary concern. So buses which has been leased out will run in her name, and permit is also obtained to that effect. Further, in the income and expenditure account, in the books of account of the SSC, the entire collections and expenditure by way of diesel, driver's salary, spares, RTO, tax etc. from the bus was shown. So the income as well as expenses are being booked by the SSC considering that she is the owner. The buses in dispute were also shown as assets in the balance sheet of the proprietary concern. The SSC claimed depreciation on these buses. So in support of her claim of beneficial ownership of the assets, she has shown loan repayment schedule, loan related documents, she has paid insurance on the buses, she has taken undertaking from the lessee and permit wherein he is able to fly the buses, whereas he is able to use the buses in her name, in her proprietary concern name, as well as the books of accounts of the SSC suggest that buses are the asset of the SSC and as well as income and expenditure thereon are also maintained are also mentioned in the books of account. Now the assessing officer's contention, the assessing officer rejected the claim of the SSC on the ground that SSC was not the owner of the three buses and the basic condition of section 32 that SSC should be the owner of the asset is not being satisfied by the SSC. The assessing officer was of the view that mere admission of income cannot per se permit the SSC to claim depreciation. As per the facts of this case, we have discussed that SSC was reporting the income in the income and expenditure account. So assessing officer is of the view that mere reporting of income in the books of account does not make the SSC the owner of the asset. And also the basic condition of section 32(1) is not being satisfied by the SSC and accordingly she cannot claim depreciation on the asset. Now what are High Court's observations? High Court observed that in the context of the Income Tax Act, having regard to the ground realities and further having regard to the object of the act is to tax the income. The owner is a person who is entitled to receive income from the property in his own right. So considering the object of the act, that is taxing the income, the owner is the person who is entitled to income from the property in his own right. Any person who is receiving the income from the property will be considered as owner as per High Court's observation. The Supreme Court in the case of CIT versus Poddar Cement Private Limited in 1997 observed that owner need not necessarily be the lawful owner entitled to pass on the title of the property to another. So as per Supreme Court ruling, an owner need not necessarily be the lawful owner. In our example that we discussed previously, wherein the difference of beneficial and legal ownership was discussed, legal owner, that is the lessee, may have to be, the asset may have to be registered in the name of the lessee as per a requirement of the act. So, as per this Supreme Court ruling of Poddar Cement, it says it is not necessary that the legal owner is the ultimate owner. And High Court's observation is that any person receiving the income may be termed as owner of the asset. Accordingly, High Court's decision was, since in this case the SSC made all the documents relating to the business, the SSC made available all the documents relating to the business and also established before the authorities that she is the beneficial owner. Accordingly, the High Court held that she was entitled to claim depreciation even though she was not the legal owner of the buses. So High Court held in favor of the SSC, wherein, based on the facts available on record, High Court held that the documents submitted by the SSC proves that she is the beneficial owner, and it doesn't matter whether she is the legal owner or not. And in support of the claim of legal owner, Supreme Court case law of Poddar Cement was cited, wherein the legal ownership of the asset is not necessary and the beneficial owner can be treated as the ultimate owner. The lessor can be treated as beneficial owner, wherein the terms of the agreement clearly states that he or she is the beneficial owner, where the ultimate risk related to the asset remains with the lessor, where if certain conditions are not satisfied by lessee, then lessor is entitled to confiscate the asset, and similar terms if are mentioned in the agreement, then the lessor continues to be the beneficial owner of the asset, and accordingly legal ownership doesn't matter, and beneficial ownership, based on beneficial ownership, the SSC can claim depreciation under section 32, and accordingly the proprietary concern was owning three buses will be entitled to depreciation, will be considered as beneficial ownership, and accordingly depreciation will be available to the SSC. Now the next case law, Madras High Court case law, Madras High Court ruling, CIT versus C Brothers Hotels Private Limited 2018. Issue under consideration: whether an SSC setting up a hotel can claim deduction under section 35 AD for the relevant previous year, where the application is approved by the authority only in the next year, where the application is approved by the authority only in the next year due to the requirement of completion of inspection. So here SSC is into the business of hotel, and the question over here is whether the deduction under section 35 AD is applicable. Yes, under normal circumstances, yes, because hotel business is one of the business specified under section 35 AD, so the SSC will be eligible for deduction. However, the scenario over here is, suppose in the previous year 1920, on April 19, the SSC has applied for application with the authorities. However, the authority approved or provided the certificate only in the succeeding previous year, that is previous year 2021. So whether deduction under section 35 AD can be claimed by the SSC in the previous year 1920 is the issue under consideration. Facts of the case: the SSC commenced operation of hotel business in the relevant previous year, in our example 1920, and filed an application for classification of hotel in April of the said previous year. So at the very start of the previous year, the application was made by the SSC and claimed deduction under section 35 AD in that relevant previous year. The assessing officer denied the benefit of deduction under section 35 AD on the ground that the SSC obtained 3-star category hotel classification only during the subsequent previous year. The assessing officer is claiming that since the application was approved only in the succeeding previous year, since the SSC obtained the approval on the classification, obtained the approval on the application only in the succeeding previous year, accordingly, no deduction will be eligible in previous year 1920. This is the contention of assessing officer. The appeal by the SSC was denied by the Commissioner Appeals, meaning Commissioner Appeals was in favor of the revenue, wherein it was held that deduction under section 35 AD will not be eligible to the SSC in the previous year 1920, while it was allowed by the tribunal. The tribunal was in the favor of the SSC, wherein tribunal allowed the deduction under section 35 AD. The tribunal's observation and view were The reasoning of the tribunal was that once the department had accepted the SSA's income, once the department has accepted the SSA's income offered to tax, the SSC was eligible to deduction under section 35AD. Once the return of income is accepted by the authorities, by the income tax department, then deduction under section 35AD cannot be denied as per tribunal's observation. As the application for 3-star category classification was granted with no discrepancy during inspection. Here, if you see the issue in consideration over here, the application was pending only because the requirement of completion of inspection. Here, the inspection was supposed to be done by the hotel management, by the Ministry of Hotel. There is a specific term to the Board of Inspection. So, the hotel inspection body was not able to complete the inspection within a prescribed time limit, and only because of that the SSC was provided was able to obtain the certificate only in the succeeding previous year. Reading this para again, as the application for 3-star as the application for 3-star category classification was granted with no discrepancy during the inspection, the SSC could not be penalized for the delay on the part of the concerned authority, the Hotel and Restaurant Approval Body and Classification Committee in the instant case. So there was a delay on the part of the Hotel and Restaurant Approval and Classification Committee to complete the inspection before the end of the previous year. Because of delay on the part of the authorities of the approval committee of the inspection committee, the SSC cannot be penalized. This was tribunal's observation, High Court's observation. So the revenue went to a higher authority. They went to High Court for the question of law. High Court's observation was that the reasons assigned by the tribunal for grant of deduction to the SSC under section were just and proper. So the High Court is supporting the view of tribunal, wherein they are saying the reason stated by tribunal are just and proper. The SSC had made an application for classification as early as in the month of April of the relevant previous year. Thereafter, an inspection was required to be conducted for such purpose. The manner in which the inspection was conducted and the time frame taken by the competent authority were factors beyond the control of the SSC. So the SSC cannot control, or it's not in the hands of the SSC that the competent authority completes the inspection within the approved time frame. The department had not disputed the operation of any new hotel from the relevant previous year, as it had accepted the return which was offered to tax. So the department has also accepted whatever is stated in the return of income by the SSC, and there was delay from the competent authority part to provide the inspection certificate. So under section 35AD, deduction is available from the previous year in which SSC commences operation of the specified business, that is the hotel business in this case. So this was High Court's observation that two factors, competent authority delay on their part and department has accepted the return of income of the SSC. Accordingly, section 35AD deduction will be applicable to the SSC in the previous year in which the SSC has applied for the certificate and SSC has commenced the business activity. Section 3580 does not mandate that the date of certificate has to be with effect from a particular date. So there is no specific provision under section 3580 that will mandate that the date of certificate should be available before commencing the business. Accordingly, the High Court upheld the tribunal's view that the SSC is entitled to claim the deduction under Section 35 AD for the relevant previous year, opining that the provision which was introduced to encourage the establishment of hotels of a particular category is a beneficial provision and hence should be read and interpreted liberally. So, High Court was also in favor of the SSC, wherein it was held that deduction under Section 35 AD will be applicable to the SSC in the previous year in which the application was made, only because there was delay on the part of the competent authority that the certificate cannot be issued under the previous year, under that particular previous year in which the business was commenced, and these factors were beyond the control of the SSC. Accordingly, considering the beneficial provision nature of the Section 35 AD, considering that it is a beneficial provision to the SSC and things were beyond the control of the SSC, the benefit of deduction under Section 35 AD should be provided to the SSC. So High Court held in the favor of the SSC, and accordingly SSC was allowed deduction under Section 35 AD. So friends, the next case law is the Supreme Court ruling, the apex court ruling in the case of Merger Paints India Limited of 2017. In this case, the issue under consideration is whether premium on subscribed share capital is capital employed in the business of the company under Section 35D to be eligible for a deduction. So the issue over here is whether premium on share capital received, whether premium received can be considered part of the capital employed or not for the purpose of calculating the deduction under Section 35D. 35D is nothing but amortization of preliminary expenses, wherein the expenses incurred by the SSC before commencement of the business are allowed as deduction to the SSC. One-fifth of the portion of the amount incurred is allowed as deduction to the SSC, and the way of calculating the deduction is 5% of the cost of the project or 5% of the capital employed by the SSC, whichever is less is allowed as deduction to the SSC. And under the definition of capital employed, the definition of capital employed is issued share capital plus debentures plus long-term borrowings. So these three terms have been included as per Section 35D for the purpose of calculation of capital employed. So the word premium is not specifically included under the definition of capital employed. Hence, the litigation whether premium on the subscribed share capital can be included, can be considered for the purpose of capital employed for calculating the deduction under Section 35D. Now, facts of the case. The SSC is a company engaged in the manufacture of paints. For the relevant assessment years, the SSC claimed deduction under Section 35D of a sum representing share premium as being part of the capital employed. So the SSC has already claimed deduction under Section 35D considering premium as part of the capital employed. The said deduction was disallowed by the assessing officer. Supreme Court's observations in this regard. The Supreme Court observed that the share premium collected by the SSE on its subscribed issue share capital could not be part of capital employed in the business of the company for the purpose of Section 35D3B. So, as per Supreme Court, premium cannot be part of the capital employed. Why so? If it were the intention of the legislature to treat share premium as being capital employed, if it were the intention of the legislature to treat share premium as being part of capital employed in the business of the company, that would have been explicitly mentioned by the legislature. So there is no specific mention as we have discussed earlier. Moreover, further analysis is column 3 of the form of the annual return in part 2 of schedule 5 of the Companies Act. In the form of the annual return under section 159 dealing with capital structure of the company, it provides the breakup of issued share capital, which does not include share premium at the time of subscription. So the annual return form of the Companies Act also does not include share premium as part of issued share capital. So issued share capital does not include share premium as per Companies Act in the form of annual return. Hence, in the absence of reference in section 35D, share premium is not part of the capital employed. Also, section 78 of the Companies Act requires a company to transfer the premium account. Requires the company to transfer the premium account to be kept in separate account called securities premium account. So Supreme Court over here taking base not only from section 35D where there is no specific mention of inclusion of securities premium in the capital employed, also under the Companies Act the annual return specifically excludes issued share capital. From the definition of issued share capital, securities premium is excluded, as well as a separate account is to be opened under the Companies Act for depositing the securities premium payment received. So, Supreme Court has taken reference not only from the Income Tax Act but also from the provisions of the Companies Act. Accordingly, Supreme Court's decision affirming the decision of High Court, the Supreme Court held that the SSC is not entitled to deduction in relation to premium amount received from shareholders at the time of share subscription. So the premium amount will not be included under the capital employed for the purpose of calculating the deduction under section 35D. Why this is important is where share capital are issued and majority of the amount is received in premium by the SSC, then the same shall be included for the purpose of deduction under section 35D, and if premium amount is included in the capital employed, then the amount of deduction will be increased. The amount of deduction which will be available to the SSC will increase, and accordingly the profit and gains for effectively 5 years will be reduced. So there are two criteria for calculating deduction: cost of the project, or to an Indian company there is an option for capital employed also. So cost of the project is always based on actual expenditure, whereas capital employed, if premium is included, then based on income received, based on funds received, a deduction can be obtained by the SSC. Hence, in absence of specific mention by the court of law, by the legislature, of not including securities premium, accordingly, the securities premium won't be included because there is no specific mention under the provisions of the law, and as per the provisions of Companies Act as well, it can be concluded that securities premium should not be part of capital employed for calculating deduction under Section 35D. So Supreme Court was not in favor of SSC in this case. Now the next case law, Mumbai High Court ruling HJ Forgings Limited of 2010, issue under consideration. Can expenditure incurred by a SSC company on higher studies of the director's son abroad be claimed as business expenditure under Section 37? So here, expenditure have been incurred on director's son studying abroad. So company is contending that the same is for the purpose of business under Section 37, and accordingly it should be allowed as deduction in the hands of the company. Now friends, here as you can see, the director's son higher studies abroad has been funded by the company. The company is claiming deduction as business expenditure. So we will have to analyze further facts. What was the purpose? He was sent outside, whether he was part of the company as an employee in any way, so that independently director's son was funded by the company. There should be no nexus between the company and the director. If there are terms which suggest, there are terms which suggest that indeed as a part of, you know, employee program, director's son has been funded for higher studies abroad, which in a way will help company in the business. So if that can be laid down, if that can be proved by the company, so in terms of the conditions, if it can be proved by the company that the expenditure is for the business purpose, then it may be allowed to the company as deduction. Now the facts of the case. SSC incurred expenditure on higher studies of director's son abroad. It was contended by the SSC that director's son was appointed as a trainee in the company under apprentice training scheme. So company is contending that he was appointed. The director's son was appointed as a trainee in the company under apprentice training scheme. So the company over here is claiming that there was a scheme for trainees, and out of this scheme and because of this scheme, director's son was eligible for higher studies abroad. However, upon perusal of the records, it was observed that there was no proof of existence of such scheme. So now, when the assessing officer is scrutinizing upon perusal of the records, he comes to know that there is no such scheme in existence. However, the company is claiming that director's son has went abroad based on the apprentice training scheme. High Court's observation in this case, the High Court observed that, so friends, in this case, generally think in this way: when an employee or contractor or trainee is appointed by the company there is a procedure which is followed by the company, which will be a proper appointment letter. First of all, a proper selection method in terms of interview of the employee or trainee or contractor, and when he succeeds in the interview, then an appointment letter. After appointment letter, is there any other process? It could be trainings in terms of, induction training to the employee. So the process followed for recruiting an employee, contractor or trainee, whether that process was followed by the company or not, that needs to be analyzed. And over here, there is only, and over here, one thing that we can see is there is no apprentice training scheme over here, first of all, which was drafted by the company, which the company is claiming that they had drafted. So assessing officer has already mentioned that there is no such scheme. Also, High Court has analyzed further documents wherein what is the conclusion, what is the observation? Let's see on the screen. On this issue, it was observed that there was no evidence on record to show that any other person at any point of time was appointed as trainee or sent abroad for higher education. So company was not able to produce any evidence where any person was appointed as trainee or sent abroad for higher education. So there is no evidence available on record whether indeed any trainee was appointed, meaning the process, whether process was followed for appointment. As per the records produced, High Court came to know that indeed there was no appointment of trainee, or in fact no one went abroad for higher education. Further, the appointment letter to the director's son neither had any reference number, nor was it backed by previous application, nor was it backed by previous application by him. So in a normal recruitment process, first you apply to the company, then company considers the application in the form of resume. The company considers the resume, and if found suitable, he is called for further process. Interview, if selected, then appointment process, so on and so forth. So here, even that application was missing. The appointment letter referred to apprentice training scheme with a company in respect of which no details were produced. Now the company had an appointment letter, but there are process missing wherein there is no application received from the trainee. There is an appointment letter. However, after that or in that document, there is no mention of apprentice training scheme. There was no evidence that he was recruited as trainee by some open competitive exam or regular selection process. So here is the point where regular selection process, regular recruitment process was not followed by the company in this regard. So the High Court held that there was no nexus between the education expenditure incurred abroad for director's son and the business of the SSC company. Therefore, the aforesaid expenditure was not deductible. Since there was no nexus in the expenditure incurred with the business of the company, no expenditure shall be allowed to the company in this case. Accordingly, the High Court ruling was not in favor of the SSC only because the company was not able to establish that there is any nexus between the education expenditure incurred on the director's son and the business of the company. Now friends, the next case law is Delhi High Court ruling. in the case of Shanti Bhushan versus CIT 2011. The issue under consideration over here is, can the expenditure incurred on heart surgery of the SSC, being the lawyer by profession, be allowed as business expenditure under section 31 or under section 37? So friends, one of the rare interesting case law that I have come across, wherein one of the body part of the individual, of the natural person, is being treated, is being contended that it is a tangible asset in the form of plant or machinery, and repairs on it, you mean to say if it is a heart surgery, so expenditure on heart surgery should be treated as repairs for business expenditure and accordingly allowed as deduction for computing income from profit and gains. This is what is a contention of the SSC in this case, and you can see that this question of law was answered by Delhi High Court. So SSC in this case has moved from not only from assessing officer commissioner appeals, he has went from tribunal to High Court for this particular point, wherein the incurred on the heart surgery expenditure incurred on the heart surgery is being claimed as business expenditure by the SSC. Let's look at the facts of the case. In the present case, the SSC is a lawyer by profession. The SSC argued that the repair of vital organ, that is heart, had directly impacted his professional competence. He contended that the heart should be treated as plant as it is used for the purpose of his professional work. He substantiated his contention by stating that after his heart surgery, his gross receipts from professional increased manifold. So here, his gross receipts were increased after the heart surgery. So he is claiming that such repair should be allowed, the heart surgery charges should be allowed to the SSC because there was improvement in his professional competence, because there was manifold increase in his gross receipts. So there was sort of improvement in his professional behavior. Professionally, there was increase in gross receipts. That's why the SSC is claiming heart surgery as a business expenditure and accordingly contending that such deduction should be allowed to the SSC. Quite interesting contention by the SSC. Hence, the expenditure on the heart surgery should be allowed as business expenditure either under section 31. 31 is nothing but repairs for plant or machinery if it is incurred for the business or profession, as current repairs to the plant or machinery, or section 37, which is a residuary section, as an expenditure incurred wholly and exclusively for the purpose of profession. So the contention of the SSC is backed by section 31 as current repairs. If not section 31, then it should fall under the residuary section, section 37, where it can be contended that the expenses are incurred wholly and exclusively for the purpose of profession. The department argued that the same is personal in nature. The department argued that the said expenditure was personal in nature and was not incurred wholly and exclusively for the purpose of business or profession, and therefore the same shall not be allowed as business expenditure. So the assessing officer has rejected the claim of the SSC, in this case, High Court's observation. This is also interesting. On your screen, on this issue, the Delhi High Court observed that a healthy and functional human heart is necessary for a human being, irrespective of the vocation, irrespective of the profession he is attached with. So, as a normal human being, a healthy heart is the most important requirement in any field, whether it is a personal life, whether it is a professional life. So, irrespective of the profession a person is in, a healthy and functional human heart is always necessary. Accordingly, expenses incurred to repair an impaired heart would thus add to longevity and efficiency of human being. No doubt, it will improve the efficiency of human being, which would be reflected in the activity he does, including professional activity. So there is bound to be an efficiency in the activity that a human being performs after heart surgery as compared to earlier. It cannot be said, as per High Court, it cannot be said that the heart is used as an exclusive tool for the purpose of professional activity by the SSC, and accordingly High Court held that point number 1 over here is against the contention of section 31, wherein to allow the heart surgery expenditure as repair expenses to plant, the heart should have been first included in the SSC's balance sheet as an asset. So whether a normal tangible asset, you take for example a general plant or machinery, you provide it in the books of accounts, and then a normal depreciation, you can say if it's a tangible asset, then you depreciate it. First of all, you value it. Value is based on actual cost of the asset that you have incurred initially, the initial outlay. Based on that, it is reflecting in your books of accounts as balance sheet, and year on year you are depreciating it and claiming depreciation. So there are series of entries, journal entries that you passed for valuing the balance sheet, for valuing the asset in the balance sheet, and also it has effect in the form of depreciation in the profit and loss account. So for such a hard expenditure, High Court is of the observation that whether you have mentioned the hard expenditure or you were able to value the hard expenditure and name it and report it in the balance sheet. There was the question of the High Court in the previous year or in the earlier years, whether such hard expenditure was included in the balance sheet by the SSC or not. Also, a value needs to be assigned for the same. A value for the purpose of reporting in the balance sheet is required for reporting it. SSC would face difficulty in arriving at such a cost of acquisition of such an asset for showing in the books of accounts. So, High Court contended that SSC won't be able to value such an expenditure in the balance sheet. Also, though the definition of plant as per the provisions of section 43.3 is inclusive in nature, in a way we are saying over here that whatever is included under the definition, there is a scope of inclusion of other activities as well, if through nature of the expenditure performed it can be concluded that it is in the nature of plant or machinery. Though the definition is inclusive definition, such plant must have been used as a business tool, which is not true in this case. In the case of heart, it is not the case. So, two contentions. First, whether heart expenditure, whether value can be assigned to a heart expenditure, and year on year it can be mentioned in the balance sheet of the SSC. And second, whether such an asset is used for the purpose of business or not. And High Court is of the observation that it cannot be said that heart is used as a business tool and used for the purpose of business. Therefore, heart cannot be said to be a plant for the business or profession of the SSC. Therefore, the expenditure on heart surgery is not allowable as repairs under Section 31 of the Income Tax Act. Second, Section 37, wherein it has been contended by the SSC that expenses have been incurred wholly and exclusively for the purpose of profession. In that case, according to the provisions of Section 37, amongst other things, the said expenditure must be incurred wholly and exclusively for the purpose of SSC's profession. As mentioned above, a healthy heart will increase the efficiency of human being in every field, including its professional work. Meaning, High Court is trying to say that no doubt expenditure has been incurred on heart surgery. No doubt there has been an improvement in the efficiency of the professional behavior. However, that is not only affecting the professional field of the SSC, but it will affect the life of the SSC entirely. So not only professional field but also personal field is affected through it. So it cannot be specifically said that it the expenses has been a business tool, the expenditure has been a business tool for the purpose of profession only. High Court's decision. There is therefore no direct nexus between the expenses incurred by the SSC on the heart surgery and its efficiency in the professional field. So there is no direct nexus. Therefore, the claim of allowing such expenditure, therefore the claim for allowing the said expenditure under 37 is not tenable, hence the heart surgery expenses should not be allowed as a business expenditure to the SSC. So, in absence of direct nexus between the expenditure incurred and the professional activity of the SSC, it can be concluded that such expenditure is not for the purpose of business or profession, it is a personal expenditure. Accordingly, the same will not be allowed as deduction to the SSC. So, meaning the heart surgery expenses were claimed by the SSC, who is lawyer by profession, which were claimed by the SSC as a business expenditure, and accordingly it may either be allowed under section 31 or 37. Such contention was not followed by the High Court, and as per High Court's observation, such expenditure will not be allowed as business expenditure as there is no direct nexus with the business activity, and accordingly no deduction is allowed to the SSC. Now friends, the next case law, Karnataka High Court ruling in the case of CIT versus Neelavati and others 2010. The issue under consideration, can payment to a police personnel and gundas to keep away from the cinema theatres run by the SSC be allowed as deduction? So payment made to police personnel and gundas in order to keep away from cinema theatres. In the case of the SSC, the SSC is into cinema theatre business, and you can say for the purpose of security of the premises, the SSC is paying a sum not only to police but also to gundas for the purpose of running the business smoothly. That's why the SSC has claimed such expenses as business deduction. such expenses as expenditure and accordingly claiming it that a deduction should be allowed only because such expenses are incurred for the purpose of business. Facts of the case: the SSC running cinema theatres claimed deduction of the sum paid to the local police and local gundas towards maintenance of the theatre. The same was disallowed by the assessing officer, and rightly so. High Court's observation on this issue: the High Court observed that if any payment is made towards the security of the business, so till now it is related to the business of the SSC, such amount is allowable as deduction. Any payment towards security of the business, any payment which has direct nexus with the business should be allowed as deduction, as the amount is spent for maintenance of peace and maintenance of law and order in the business premises of the SSC, that is cinema theatres in the case. So High Court observed that the expenditure has been incurred for security of the business. The expenditure is spent for maintenance of peace and maintenance of law and order in the business premises in the cinema theatres. So in a way, till now it is related to the business of the SSC. However, the amount paid by the SSC in the instant case was towards payment made to police and gundas. So the person towards whom the payment is directed, the person to whom the payment is made is relevant in this case. It is no doubt that the SSC has made the payment for maintenance of business, for security of the business. However, here the payment has been made to local police and gundas. Any payment made to police illegally amounts to bribe. Payment to police illegally amounts to bribe, and such illegal gratification cannot be considered as an allowable deduction. Payment was no doubt a business expenditure, in the nature of business expenditure, had direct nexus to the business as well. However, since the payment was made to police, local police, it can be termed as bribe and accordingly illegal. And as per section 37, any illegal expenses are never allowed as deduction. Similarly, any payment to a gunda as a precautionary measure so that he shall not cause any disturbance is also an illegal payment for which no deduction is allowable. So both the payments will be termed as illegal. So as per the provisions, you can see the expenses were qualifying as a business reduction. However, since the payment was made to local police or gunda and the purpose of payment was, and the purpose of payment can be termed in this regard that it is an illegal payment as per section 37, and accordingly no expenses will be allowed to be deducted. High Court's decision: if the SSC had incurred expenditure for the purpose of security, the same would have been allowed as a deduction. However, in the instant case, since the payment has been made to the police and gundas to keep them away from the business premises, such a payment is illegal and hence not allowable as deduction. This was the decision of Karnataka High Court, and such payment was termed as illegal as per section 37, and accordingly nothing will be allowed to the SSC. Now friends, the next case law is Karnataka High Court ruling in the case of Millennia Developers Private Limited versus DCIT 2010. In this case, the issue under consideration is the amount paid by a construction company as compounding or regularization fee for violating building bylaws allowable as deduction. So here the construction company, the SSC, has paid compounding fee wherein the company has violated the bylaws, because of which the company is required to pay a compounding fee, or in another term, in layman terms, a penalty is required to be paid for violation of the bylaws. So whether such a penalty fee or a compounding fee can be allowed as deduction to the SSC or not is the issue over here. Facts of the case: the SSC, a private limited company carrying on business activity as a developer and builder, claimed the amount paid by way of compounding fee for the deviations made while constructing a structure and for violating the plan sanction. So there is a violation of plan sanction in terms of the building bylaws approved by the municipal authorities as per the provisions of Karnataka Municipal Corporations Act 1976. So there was a violation of the bylaw by the developer and builder. The SSC's claim was disallowed by the assessing officer and the disallowance was confirmed by the tribunal. So the assessing officer didn't allow such deduction, as well as the tribunal also was not in favor of the SSC. High Court's observation and decision. As you can see, before moving on to the decision, the conclusion should be that a penalty fee, effectively a penalty fee is paid by the SSC. So as per section 37, a penalty fee would not be allowed as deduction to the SSC, and here it's a sort of violation of the bylaws, and the compounding fee in a layman term will be termed as the nature of the fee is nothing but penalty. So here the substance over form principle was applied by the High Court, wherein whatever fee paid by the SSC, ultimately the nature of the payment, ultimately the nature of the fee paid is nothing but penalty. Accordingly, it will be disallowed as per section 37 of the Income Tax Act. On the screen, the High Court, Karnataka High Court, observed that as per the provisions of the Municipal Corporation Act 1976, the amount paid to compound an offence is obviously a penalty. Any fee paid for compounding an offence is nothing but a penalty and hence does not qualify for deduction under section 37. Merely describing the payment as a compounding fee would not alter the character of the payment, would not alter the nature of the payment, which is ultimately penalty. The principle of substance over form has been applied in disallowing an expenditure in the nature of penalty, though the same has been described as regularization fee or compounding fee. So principle of substance over form will be considered, and ultimately the compounding fee will be termed as penalty, and the compounding fee paid would not be allowed as deduction under section 37 to the SSC. So Karnataka High Court, along with tribunal and the assessing officer, were not in favor of the SSC, held not in favor of the SSC, and deduction under section 37 accordingly is not permitted on a compounding fee paid for violation of the building bylaws. Now the next ruling is held by Apex Court ruling, Supreme Court ruling in the case of Pelham Gas Service versus CIT 2017 394 ITR 300 Supreme Court. Issue over here is whether section 40A IA, which is nothing but disallowance of expenditure in case TDS is not deducted, is attracted, whether such section is attracted when amount is not payable to a subcontractor but has been actually paid, where the amount is not payable, but however, the amount has actually been paid. In such a scenario, whether this allowance of expenditure can be done where TDS was supposed to be deducted. So here, the assignee has made the payment for the services rendered by the contractor, and after making the payment has been made and TDS is not deducted. So the contention of the SSC is that the payment has actually been made, whether TDS was required to be deducted, where the section says that TDS is required to be deducted on payable basis. This is the contention of the SSC. Facts of the case: the SSC Pelham Gas Service is engaged in the business of purchase and sale of LPG cylinders. The SSC had arranged for the transportation to be done through three subcontractors within the meaning of Section 194C. So SSC is into purchase and sale of LPG cylinders, for which he has arranged the services of three subcontractors, for which TDS was liable to be deducted under Section 194C. During the relevant assessment year, when the SSC made freight payments to subcontractors, it did not deduct tax at source. So while making payment, SSC failed to deduct any tax, and accordingly, since the taxes were deductible under Section 194C and the payment was made, so the payment made to subcontractors will be disallowed in the hands of the SSC as per Section 40A IA. Accordingly, the assessing officer disallowed the freight expenses as per Section 40A IA on account of failure to deduct tax at source. So, assessing officer has disallowed the freight expenses since taxes were not deducted. The SSC contended that Section 40A IA did not apply as the amount was not payable but has been actually paid. So since the amount has already been paid, there is no question of the amount being payable and there would be no question of deducting any taxes, any TDS. So that's the contention of the SSC. On that, Supreme Court's observation. Supreme Court noted the difference in opinion amongst the various high courts, and what Supreme Court observed is there are several high court case law wherein it has been held that where the taxes have been paid, where the expenditure is already paid, it will include payable cases as well, meaning where an expenditure is incurred, the taxes are payable. I mean, the TDS is deductible on paid or payable basis, whichever is earlier. So, the High Court was of the opinion, several High Courts, which has been quoted by the Supreme Court in this case law, all the High Court were in favor that TDS is applicable on payable case as well as on the paid cases. Meaning, to speak on this, to clarify this point further, the method of accounting followed by the SSC. So, if a accrual method, mercantile basis method is followed by the SSC, then tax or expenditure, the expenditure is supposed to be shown in the books of accounts on accrual basis even if the same is not paid. However, the liability, if accrued, is supposed to be shown in the books of accounts. If method of accounting followed is accrual basis, mercantile basis, and if method of accounting followed is cash basis, then entries are passed based on payment. So this is the difference between method of accounting. Similarly, here the difference between payable and paid is to be analyzed, wherein the SSC is effectively saying that if my books are followed with mercantile system of with cash method of accounting. If the method of accounting followed by me is cash system, then only paid basis should be followed and not payable basis. Taxes were deducted not on payable basis but on paid basis. This is the contention of SSC, and this is what Supreme Court is trying to observe and analyze. On the other hand, on the one hand, the high courts of Punjab and Haryana, Madras, Calcutta, and Gujarat held that Section 40AIA extended to amount actually paid. The Allahabad High Court, the Allahabad High Court had, however, held otherwise. So here there are differing opinions. One favorable, there are High Court case law where it is being held that 40AIA is applicable to cases where amount has actually been paid, whereas Allahabad High Court is of the opinion that where expenses are already incurred, already paid, then 40AIA is not applicable. TDS provisions are not applicable. So there are differing of opinions between the High Court. However, most of the High Courts are of the view that TDS is to be deducted on the amount actually paid as well. The Supreme Court agreed with the observations of majority of high courts and held that 40AIA covers not only those cases where the amount is payable but also when it is paid. So the Supreme Court goes on with the opinion with the observations of majority of high court where the amount payable and as well as the amount paid on both the TDS provisions are applicable. Accordingly, the judgment of Allahabad High Court in the case of CIT versus Vector Shipping Services Private Limited stands overruled. So, the only Allahabad High Court which had a differing opinion wherein only amount payable is to be considered for TDS provisions was overruled by the Supreme Court. So, the Allahabad High Court ruling was overruled. The Supreme Court reaffirmed that the obligation to deduct tax at source is mandatory and applicable irrespective of the method of accounting adopted. So, irrespective of the method of accounting adopted by the SSC, the TDS provisions will continue to apply. This is what Supreme Court has reaffirmed, reiterated. If the SSC follows the mercantile system of accounting, then the moment amount was credited to the account of the payee on accrual of liability, the tax was required to be deducted at source. Mercantile system of accounting also, tax will be required to be deducted at the time of payable of the amount, and if there is a cash system of accounting, then tax is required to be deducted at source at the time of making payment. Meaning, again, Supreme Court has rightly said that TDS provisions are bound to be applicable irrespective of the method of accounting followed by the SSC. If it is mercantile system, then the amount is taxable on payable basis. TDS is required to be deducted on payable basis, and if method of accounting followed is cash system, then at the time of the payment of the expenditure, TDS is required to be deducted by the SSC. So there is a reference of method of accounting employed by the SSC, and there is a reference of several high court case law which are in favor of the opinion that TDS provisions are applicable on the amount payable as well as on the amount paid, against which is against the contention of the SSC, which has relied on the Allahabad High Court, wherein it was held that TDS is only applicable on amount paid and not on payable. Did not apply to the amount. The amount was not payable, actually paid. Yes. So it has been rightly held or incorrectly observed by the Allahabad High Court over here. This is what I was trying to confirm by going backwards. And the Allahabad High Court case law was overruled by the Supreme Court. Supreme Court held that the Supreme Court accordingly upheld the decision of the majority high courts that Section 40 AIA would be attracted for failure to deduct tax in both cases. In both cases, that is, when the amount is payable or when the amount is paid, as the case may be, depending on the system of accounting followed by the SSC. So, TDS provision will continue to apply irrespective of the method of accounting followed by the SSC. This is one of the principles which is coming out of this case law, wherein if there is any ambiguity on the TDS provisions applicability, whether TDS provisions won't be applicable when amount is payable or TDS provisions are not applicable when the amount is paid. If there is any ambiguity regarding such provisions of deduction of TDS based on the method of accounting followed, so as per this case law, it has been settled wherein TDS provisions will continue to apply and it is not dependent on the method of accounting followed by the SSC. So this ruling in this particular case was not in favor of the SSC, and Supreme Court accordingly held that SSC was required to deduct tax at source, and accordingly the expenditure paid to the subcontractors as freight charges won't be allowed to the SSC as deduction. And 40 AIA, 30% of the tax, 30% of the expenditure won't be allowed as deduction. Now friends, the next case law, it's the Delhi High Court ruling in the case of CIT versus Maruti Suzuki India Limited. Issue under consideration: can payments made by an SSC to a non-resident agent who does not have any income accessible in India. The non-resident agent does not have any income accessible in India, whether such payment will be disallowed under 40 AI for non-deduction of tax at source. So the SSC has made the payment to a non-resident agent, and whether on such payment TDS provisions are applicable is the question, is the issue. And the fact which has been mentioned in the issue under consideration is the non-resident does not have any accessible income in India. So from this it can be inferred, we can come to an opinion that the non-resident agent does not have any income sourced from India or any income which is accrued from India. Accordingly, the TDS provisions, or accordingly no TDS is deducted by the SSC. Accordingly, the payment made by the SSC, if the same is not chargeable to tax in the hands of the non-resident agent, then TDS provisions won't apply. So the first question is whether such payment is an income chargeable in hands of the non-resident or not. And the same question is asked by section 195, wherein any payment to the non-resident, TDS provisions will apply only if the payment made is an income chargeable to income tax. Only if the income is chargeable to tax under the provisions of the domestic law, then only section 195 apply, then only the TDS provisions will apply where the payment is made to a non-resident. So the issue over here is whether TDS provisions will apply or not, and solution could be, or the question to search for is whether the payment made by the SSC to the non-resident was chargeable to tax or not. Facts of the case: the issue relates to payments made by the SSC to its agents based and operating abroad. The agent had no assessable income in India. The agent had no assessable income in India, so there could be a possibility that such payment is not chargeable to income tax in India, and accordingly TDS provisions may not apply. The assessing officer disallowed the payment invoking section 40AI on the ground that no application was made by the SSC under section 195 subsection 2. As per section 195 2, wherein the SSC thinks that the payment to be made to the non-resident, there will be no tax applicable, then the SSC shall apply to the assessing officer for a lower withholding certificate, lower rate of certificate, or a nil rate of certificate. So the SSC is required to make an application where a lower rate is applicable or nil rate is applicable on the payment made to the non-resident. So assessing officer is of the opinion that since no application was made by the SSC under subsection 2 of section 195, hence such payment won't be allowed as deduction. Commissioner appeals and the tribunal, however, allowed the deduction. So the assessing officer disallowed the payment, disallowed the expenditure. However, the commissioner appeals and the tribunal allowed the deduction to the SSC. High Court's observations. The High Court observed that the non-resident agent who operated outside India did not have any income arising in India. In order to come to this conclusion, the High Court relied on CIT versus Model Axioms 2013 358 ITR 72 Allahabad, where it was held that there was no obligation to deduct tax under section 195 from commission paid to non-resident recipient who was not liable to tax in India. So here is the solution that we were searching, or that we wanted answer for, where it was held that there was no obligation to deduct tax under section 195 where commission paid to non-resident was not liable to tax in India. This was High Court ruling in the case of Model Axioms. Another case law which was relied by Delhi High Court further in CIT versus Gujarat Reclaim and Rubber Products Limited 2016 383 ITR 236 Mumbai High Court. It was held that the commission earned by a non-resident agent who was in the business of selling Indian goods abroad did not accrue or arise in India, and hence no tax was deductible on such commission payment to a non-resident agent. Since the income did not accrue or arise in India, hence no tax was deductible on such commission payment to a non-resident agent. So again, this case law stated, both the case law quoted over here stated that if the amount is not chargeable to tax under the income tax, then no TDS is required to be deducted. TDS provisions won't apply. High Court held that where the SSC has made payment to a non-resident agent where such income is not chargeable to tax in India, where the SSC has made payment to a non-resident agent where the income is not chargeable to tax in India, section 40AI could not be invoked to disallow deduction of such payment for non-deduction of tax at source while computing the business income of the SSC. Accordingly, since the payment is not chargeable to tax in India, nothing will be taxable in the hands of non-resident agent, and accordingly TDS provisions won't apply in this case. So the Delhi High Court ruling in the case of CIT versus Maruti Suzuki India Limited is in favor of the SSC, wherein the payment made to the non-resident agent won't be taxable. In India, the non-resident agent is not chargeable to tax in India. Accordingly, TDS provisions won't apply. And as per Section 195, where amount paid is not chargeable to tax, TDS provisions won't apply where the payment is made to a non-resident outside India. Now friends, the next case law is Allahabad High Court ruling CIT versus Great City Manufacturing Company 2013 351 ITR 156 Allahabad. Issue under consideration is, can remuneration paid to working partners as per partnership deed be considered as unreasonable and excessive as per section 40A2A, even though the same is within the statutory limit prescribed under section 40B. So the issue over here is where the payment of salary, remuneration, interest to the partners is within the statutory limit as per section 40B, then whether the assessing officer can invoke provisions of 40A2 and claim that the payment to the partners is unreasonable, is excessive as compared to other employees, and disallow such expenditure. Can assessing officer do that? Is the issue under consideration. So, statutory limit prescribed as per 40B is fulfilled, and whether section 40A2 can be invoked in this regard is the question. Now the facts of the case. In this case, the assessing officer contended that the remuneration paid by the firm to its working partners was highly excessive and unreasonable on the ground that remuneration to partners was many times more than the total payment of salary to all the employees. So the assessing officer was of the view that remuneration to partners was many times more than the total payment of salary to all the employees, and accordingly it is unreasonable, excessive, and it could be disallowed under section 48(2). Therefore, he disallowed the excessive portion of the remuneration to partners by invoking the provisions of section 48(2)(a). High Court's observation. So friends, before going on to the observation part, in the instant case, the statutory limit of 40B is being satisfied, wherein the other factor which could also be seen is what the partnership deed says in this case. And if the payment to the partners is as per the partnership deed and the statutory limit of 40B is also followed, is also satisfied, so in this case, both the factors taken together, can it be concluded that nothing is excessive, nothing is unreasonable? If both the factors are satisfied, wherein partnership deed terms are followed, statutory limit of section 40B is followed, if both the provisions are followed, if both the factors are followed by the partnership firm while making the payment, then there shouldn't be invoking of the provision 40A2 being allowed. So as per my view, it could be, that if you're following a particular law 40B, then another provisions should not be invoked again, and also you have factor that partnership deed factors terms If they are also satisfied, then other provisions of the Act shouldn't be invoked to unnecessarily harass the partners or the partnership firm. High Court's observation on this issue: the High Court observed that Section 40b(5) prescribes a limit of remuneration to working partners, and deduction is allowable up to such limit while computing the business income. Fine. If the remuneration paid is within the ceiling limit provided under Section 40b(5), then recourse to the provisions of Section 48(2)(a) cannot be taken. This is observation of High Court. The assessing officer is only required to ensure that remuneration is paid to the working partners mentioned in the partnership deed. So here, whatever is mentioned in the partnership deed, the terms and conditions of the partnership deed provide for payment of remuneration to the working partner, and the remuneration is within the limits of 40b(5). So partnership deed read with Section 40b. If both the conditions are satisfied, then 40a(2) cannot be invoked. If these conditions are complied with, the assessing officer cannot disallow any part of the remuneration on the ground that it is excessive. This is High Court's observation. Accordingly, High Court held that the question of disallowance of remuneration under Section 48(2)(a) does not arise in this case, since the tribunal has found that all the three conditions mentioned above has been satisfied. Hence, the remuneration paid to working partners within the limits specified as per Section 40b cannot be disallowed by invoking the provisions of 40a(2)(a). So the High Court, Allahabad High Court, was in favor of the SSC, and assessing officer was not allowed with the contention that even 40a(2)(a) can be invoked and excessive payment can be disallowed in the hands of the partner. So friends, the next part of the case law is case laws related to expenditure, whether the expenditure should be included as revenue expenditure or capital expenditure. Friends, a capital expenditure whether to be treated as revenue or capital has been a matter of litigation since several decades now, and you will always find n number of case laws on this topic which is related to revenue expenditure versus capital expenditure. Today we will be seeing in this part of the case law there are three case laws covered which has been held by different court of law, different courts, whether an expenditure will be revenue or capital expenditure in different fields, and always an SSC, from SSC's point of view, SSC will always feel that expenditure is revenue. He will be more inclined to treat an expenditure as revenue expenditure only because if an expenditure is revenue, 100% deduction will be allowed to him in the relevant previous year itself, vis-a-vis when compared to capital expenditure, wherein the expenditure is allowed to the SSC in several installments, which may go up to 5 years. So, if you see in this case law, SSC will always contend that a particular expenditure is revenue expenditure, and department assessing officer will contend that a particular expenditure is capital expenditure, and without doubt such expenditure has been incurred by the SSC for the purpose of business or profession. So that expenditure is bound to be allowed to the SSC, but whether it is to be allowed as revenue expenditure or capital expenditure will be seen in this case law, that we will see in this case laws. So first is Delhi High Court ruling, which is CIT versus Orient Ceramics Industries Limited, 2013. Friends, in this case, the issue under consideration was whether expenditure incurred on glow sign boards displayed at dealer outlets, whether it is a capital expenditure or revenue expenditure. So it is a normal practice, you can say, wherein at times the manufacturer or the main dealer would want his agent or sub dealer to display the brand name of the company while selling the product. So it may be that that particular sub dealer is into that particular brand only, and if so, then the main dealer will ask him to display the brand name while dealing with the products of the company. So here a glow sign board is being displayed at the sub dealer outlet, and whether such expenditure is revenue or capital expenditure is the issue under consideration. So such expenditure, no doubt it is advertisement expenditure which is for the purpose of business or profession, so in any ways it will be allowed to the SSC. However, whether it will be allowed in installments by way of depreciation or whether it will be allowed 100% by way of revenue expenditure, that is the issue under consideration. So what was held by Delhi High Court in this case? They relied on Punjab and Haryana High Court in the case of Liberty Group Marketing Division, wherein the facts of the case were similar. Issue under consideration therein also was similar, wherein whether expenditure on glow sign boards should be allowed as revenue or capital expenditure to the SSC. In that, they contended that they held that whether the advantage is of enduring nature or not, enduring benefit or not to the SSC. If the expenditure is such through which the benefit is enduring nature, the benefit is of enduring nature to the SSC, then it will be a capital expenditure. So the benefit, if it is bound to be there for several years to the SSC, it will be a capital expenditure. If not, then it will be a revenue expenditure. So permanent nature or temporary nature is the point of contention. Also, the Punjab and Haryana High Court held that for the purpose of glow sign boards, the SSC was supposed to incur certain normal expenditure, such as whether the lights are functioning properly or not, or whether there are any repairs or maintenance. Simple repairs or maintenance are required for affecting the signboards correctly so that the signboards function correctly. And in that case, the SSC had to incur certain expenditure to make sure that the signboards are functioning properly at a regular intervals. So in that case, Punjab and Haryana High Court held that the expenditure on glow sign boards was a revenue expenditure because there was not a benefit of enduring nature to the SSC. The expenditure were not permanent in nature, and the SSC had to incur regular repair and maintenance expenses on the glow signboard. Accordingly, it was held that such expenditure is revenue in nature, and relying on that ruling, Delhi High Court, in the case of Orient Ceramics Industries Limited, held that such expenditure on glow sign boards will be a revenue expenditure and it will be allowed in the year in which it is incurred by the SSC. So issue under consideration, High Court's observation on this issue, the Delhi High Court noted the following observations of Punjab and Haryana High Court in the case of Liberty Group Marketing Division 2009. Expenditure. The expenditure incurred by the SSC on glow sign boards does not bring into existence an asset or advantage for the enduring benefit of the business. So there is no enduring benefit to the SSC which is attributable to the capital, The glow sign board is not an asset of permanent nature. It has a short life. The materials used in the glow sign boards decay with the effect of weather. Therefore, it requires frequent replacement. The wordings frequent replacement. Consequently, the SSC has to incur expenditure on glow sign boards regularly in almost each year. So there are regular repair and maintenance cost. There is a regular replacement cost for the SSC. The SSC incurred expenditure on the glow sign boards with the object of facilitating the business operation and not with the object of acquiring asset of enduring nature. Accordingly, Delhi High Court, relying on the Punjab and Haryana High Court, held that such expenditure was revenue in nature. The Delhi High Court agreed with the above observations of Punjab and Haryana High Court and held that such expenditure on glow sign boards displayed at dealer outlets was revenue in nature. So this will be revenue in nature and accordingly allowed to the SSC in the year in which it is incurred. So Delhi High Court held in favor of Orient Ceramics and Industries Limited and the expenditure was held to be revenue in nature. Next case law again related to capital or revenue expenditure. In this case, the issue under consideration was a feasibility study was conducted by a company which is engaged into cinema halls, cinema theaters. The entity want to explore an opportunity wherein what will be the cost where a single screen cinema theater is to be converted into multiplex, multi screens cinema. So, company incurred certain expenditure on the same, wherein a feasibility study was conducted. What are the possibilities of conversion to a multi-screen theater? However, due to financial crunch, the company had to abort the plan of conversion of single screen cinema to multi-screen cinema. In such a case, the SSC contended that such expenditure should be allowed because it is part of the existing business and it has been incurred for the purpose of business or profession, for the purpose of extension of business or profession, and the same should be allowed as revenue expenditure. However, assessing officer contended that it is a capital expenditure and should be allowed as depreciation and not as revenue expenditure. We will first read issue under consideration and facts of the case, then we will go to what was held by Delhi High Court. Delhi High Court ruling in the case of CIT versus Priya Village Roadshows. Issue under consideration: would expenditure incurred on feasibility study conducted for examining proposals for technological advancement relating to the existing business be classified as a revenue expenditure when the project was abandoned without creating a new asset? So it is related to existing business, whether it will be a revenue expenditure where the project was abandoned midway. Facts of the case: in this case, the SSC engaged in the business of running cinemas, incurred expenditure towards architect fee for examining the technical viability of the proposal for takeover of cinema theatre for conversion into multiplex, four screen cinema complexes. The project was, however, dropped due to lack of financial and technical viability. So the project was dropped midway. In this case, the High Court observed that there is no new asset which is coming into existence. This is only part of the existing business and it is part of a common administration. The funds have been incurred from the common fund and the revenue, the expenditure will be revenue in nature. This was held by the High Court. Only because this was part of the existing business, the expenditure were incurred from the common funds and it is part of the common administration of the existing business. Accordingly, it was held that it is revenue in nature. On this issue, I could observe that in such cases, whether or not a new asset comes into existence would become a relevant factor. If there is no creation of new asset, then the expenditure incurred will be revenue in nature. So whether or not a new asset is coming into existence would be a relevant factor over here. Since the feasibility studies were conducted by the SSC for the existing business with a common administration and common fund, and the studies were abandoned without creating a new asset, the expenses were of revenue nature. So, existing business with a common administration and common fund, and no new asset is coming into existence. Accordingly, the expenditure is revenue in nature in the absence of any new creation of asset, and which was nothing but extension of the existing business and extension of the common administration common fund. Accordingly, Delhi High Court held in favor of the SSC, wherein the expenditure for conducting feasibility study by way of architect fee, payment by way of architect fee was allowed as a revenue expenditure to the SSC. Now friends, and next is case law related to an expenditure, whether it should be revenue or capital expenditure, wherein the issue and the consideration was whether expenditure incurred by the SSC for the purpose of business or profession, for the purpose of business by way of alteration of a dam, for the purpose of obtaining water for the SSC's plant facilities. So the SSC has already, there is a plant placed nearby water, nearby a dam which has been constructed by the state government. The company, the SSC, requires water for the dam for the purpose of operations related to plant, and the SSC had to conduct certain alterations to obtain the water from the dam to the plant. Whether such expenditure which has been incurred by the SSC, which is related to alteration of dam for obtaining water, is a revenue expenditure or capital expenditure, is the issue under consideration. Rajasthan High Court ruling Hindustan Zinc Limited, issue under consideration: can expenditure incurred on alteration of a dam to ensure adequate supply of water for the smelter plant owned by the SSC be allowed as a revenue expenditure? So expenditure has been incurred for alteration of a dam to ensure adequate supply of water for the plant which is owned by the SSC, whether it is a revenue expenditure or capital expenditure, is the issue under consideration. Facts of the case: the SSC company owns a super smelter plant which requires large quantity of water for its day-to-day operation, in the absence of which it would not be able to function. This is important. The SSC won't be able to function without the use of the water of dam. So it will be necessary for the SSC to do such construction, to incur such expenditure, so that water is made available to the plant and accordingly operational activity commences. The SSC therefore incurred expenditure for alteration of the dam which is constructed by the state government to ensure sharing of the water with the central, with the state government, without having any right or ownership in the dam or water. Obviously, the dam or water is not owned by the SSC. However, with the permission of the state government, the SSC wants to use water for its plant facilities. Only when the water will be available, the plant activities, the operational activities of plant will commence. Accordingly, such expenditure is very much necessary for the purpose of business. And considering that the expenditure is necessary for operational activities and the same is incurred for the purpose of business, it will be allowed as revenue expenditure to the SSC. The SSC share of water is also determined by the state government. The SSC claimed the expenditure as deduction under Section 37, which was disallowed by the assessing officer on the ground that it was a capital expenditure. So SSC claimed it as revenue expenditure. However, assessing officer is of the view that it is a capital expenditure. Tribunal's view, tribunal held in favor of the SSC, concluding that it is an operational activity. It is in the nature of trade operation, and only after that the operational activities of the SSC will commence. The tribunal, however, was of the view that since the object and effect of the expenditure incurred by the SSC is to facilitate its trade operation, and enable the management to conduct business more efficiently and profitably, the expenditure is revenue in nature and hence allowable as reduction. Since to commence the operation, the expenditure is necessary for the trade operation, the expenditure was allowed as deduction, was allowed as revenue expenditure to the SSC. So High Court's observations and decision, High Court also held in favor of the SSC, wherein the commercial expediency was put forth and the necessity of the expenditure was put forth, clearly highlighting that such activity is an operational activity and it is necessary for the conduct of the business and it will not be in the capital expenditure. The High Court observed that the expenditure incurred by the SSC for commercial expediency relates to carrying on of business. Expenditure is of nature which a prudent businessman may incur for the purpose of business. Operational expenses incurred by the SSC solely intended for furtherance of the enterprise can by no means be treated as capital expenditure. So Rajasthan High Court was in favor of the SSC, Hindustan Zinc Limited, wherein expenditure incurred for alteration of dam to obtain water for the purpose of operating the plant was allowed as revenue expenditure to the SSC. Now friends, continuing with the next case law, which is between Confederation of Indian Pharmaceutical Industry versus CBDT, and the ruling was given by Himachal Pradesh High Court ruling. In this case, the issue under consideration was whether freebies given by pharmaceutical companies to the medical practitioners should be allowed as deduction to the pharma company or not. So, pharma companies are preparing their products, are manufacturing their products, and they are given as free samples to the medical practitioners so that the medical practitioner may refer the same to the patient. So such freebies, such free samples given by the pharmaceutical companies should be allowed to be deducted in the books of accounts of the pharma company or not is the question. Here there are three scenarios, or you can say three provisions. First, what does the Indian Medical Council regulation say? Indian Medical Council related to ethics to be followed by pharmaceutical company. The Indian Medical Council rule says that such freebies, such free samples provided by pharmaceutical companies is not allowed as per rules. Meaning, such free samples should not be provided to medical practitioners. If at all it is provided, it is prohibited by law. It is prohibited by the rules and regulations of Indian Medical Council Professional Conduct Ethics 2002 regulations. This was the first point. Second point is there was a circular issued by CBDT in 2012 wherein they have given reference to Section 37. Second and third point are the same. wherein a reference to section 37, explanation to section 37 has been provided, wherein any expenditure which is prohibited by law for the time being in force will be illegal in nature and accordingly won't be allowed as deduction in the books of accounts of the SSC. So Indian Medical Council states that such free samples should not be provided by a pharmaceutical company to the medical practitioners. So it is prohibited by rules and regulations, and applying that principle, section 37 says since it is prohibited by a law in force, since distribution of free samples is prohibited by a law in force, which is Indian Medical Council regulations, accordingly any expenses thereon cannot be claimed as deduction as it is prohibited by law and it is illegal. And to affirm that, CBDT issued a circular in 2012 wherein it was confirmed that such free samples provided by the pharmaceutical companies won't be allowed as deduction to the SSC. Now, in response to that, the pharmaceutical companies are claiming that such a circular in the income tax provision is overriding the regulations, meaning circular cannot override, cannot be above the provisions of the law. This was one of the contention of the SSC, wherein Himachal Pradesh High Court observed that the circular is not overriding the provisions of the law, is not overriding the provisions of the Income Tax Act. The same is in line with the existing provisions. The same is in sync with the existing provisions because the circular is only trying to say what has been iterated by section 37, and section 37 says that if anything is illegal, if anything is prohibited by law, the same won't be allowed as deduction, and this is what is affirmed by the circular, and accordingly the same is in line with the provisions of section 37. Accordingly, what High Court held in this case was circular is in line with the existing provisions of the Act, and accordingly such free samples given by the pharmaceutical company to the medical practitioners won't be allowed as deduction to the SSC to the pharmaceutical company. So the ruling was not in favor of the SSC, and rightly so, because such free samples given are against the public policy and to be in favor of public at large, and to discourage such practice, such regulations have been imposed, and if you are not following such regulations, then you will not get deduction under the Income Tax Act also. So this was the message, and the provisions of the income tax law are synced with the Indian Medical Council regulations. On your screen, issue under consideration in the case of Confederation of Indian Pharmaceutical Industry SSI versus CBDT. In this case, the ruling was from Himachal Pradesh High Court. Issue under consideration, correlation between circular issued by CBDT in 2012 disallowing the expenditure incurred on freebies provided by pharmaceutical companies to medical practitioners, and explanation to section 37(1) which disallows expenditure which is prohibited by law. So circular and section 37, the correlation between the two has to be established, whether both are in sync, whether CBDT circular is overriding the provisions of section 37 or not. High Court's observations: as per Indian Medical Council, Professional Conduct, Etiquette, Ethics, Regulations 2002, every medical practitioner and his or her professional associate is prohibited from accepting any gift, travel facility, hospitality, cash, or monetary grant from any pharmaceutical and allied health sector industries. So the medical practitioner is straightforward, prohibited from accepting any type of gift, from accepting any type of monetary grant from the pharmaceutical companies in order to protect the interest of the patients and public at large. Considering the increasing complaints against the medical practitioners prescribing branded medicines instead of generic medicines, so you can see the effects over here, wherein free samples are provided to the medical practitioners, and medical practitioners, some of the medical practitioners are indulging in practice of suggesting branded medicines instead of generic medicines solely, and this was done solely in lieu of gifts and other freebies granted to them by some particular pharmaceutical industries. The CBDT has wide circular number 5 2012 dated 1st of August 2012 clarified that the expenditure so incurred by the pharmaceutical company shall be inadmissible under section 37(1). The CBDT has given the background wherein medical practitioners are indulging in practice of suggesting branded medicines which are provided by pharmaceutical companies, and generic medicines are not being prescribed. So, in line with the Indian medical regulations, Indian Medical Council regulations, CBDT has issued the circular. High Court held that the contention of the SSC that the above mentioned circular goes beyond Section 37(1) was not acceptable. Why? Because as per the explanation to Section 37(1), it is clear that any expenditure incurred by an SSC for any purpose which is prohibited by law shall not be deemed to have been incurred for the purpose of business or profession. Right? The sum and substance of the circular is also the same. Therefore, the circular is totally in line with the explanation to Section 37(1). So, High Court held that it is not overriding the existing provision. However, it is in sync with the provisions of Section 37(1) and in line with the explanation to Section 37(1). However, here a way out has been given to the medical practitioner in the last para, wherein if he can prove that in genuine circumstances the same has been, the freebies have been taken, then expenditure may be allowed to the pharmaceutical company. So an opportunity of being heard is being provided to the pharmaceutical company, wherein in genuine circumstances such freebies have been provided to the medical practitioners, then a deduction under section 37(1) may be allowed. However, the onus to prove is on the SSC, is on the pharmaceutical company, not the assessing officer. Accordingly, however, if the SSC satisfies the assessing authority that the expenditure incurred is not in violation of the regulations framed by the Indian Medical Council, then it may legitimately claim a deduction, but it is for the SSC to satisfy the assessing officer that the expense is not in violation of the Indian medical regulations. So SSC to satisfy the assessing officer that the expense is not in violation of the regulations. A way out has been provided by the High Court, wherein an opportunity of being heard will be provided to the pharmaceutical company, and the onus to prove that the expenses, that such freebies were not provided in prohibition of the Indian Medical Council regulations, then such expenditure may be allowed to the SSC. So friends, three parts to it. First, Indian Medical Council regulations of 2002, then circular issued by CBDT which was in line with section 37(1), explanation to section 37(1), wherein the freebies provided by the pharmaceutical company to the medical practitioners and expenditure claimed by such pharmaceutical companies in the books of accounts was not allowed, only because such free samples were prohibited by Indian Medical Council regulations and accordingly will be illegal for the purpose of deduction under section 37(1). Explanation to section 37(1), read with CBDT circular of 2012. So the ruling was against the SSC and deduction wasn't allowed to the SSC. Now friends, moving on to the next case law, which is held by Punjab and Haryana High Court in the case of CIT versus CAP Scan Diagnostic Center Private Limited 2012. Friends, here the issue under consideration is commission provided by the diagnostic center to the medical practitioners, to the doctors, whether such commission should be allowed as deduction under the income tax provisions or not. So there is a tie-up between doctor and diagnostic center. Whenever a patient visits doctor and if he has requirement of services of diagnostic center, then doctor can refer the same to the diagnostic center. That is fine. I mean, the doctor can refer. The only thing is, if any commission is paid by diagnostic center to the doctor, then that expenses are prohibited or not, are against the law or not, and if they are against the law, then such a deduction won't be allowed as deduction to the diagnostic center. Fine. So facts of the case: doctor has referred the patient to diagnostic center and diagnostic center has paid in return of such referral, has paid commission to the doctors, and now the diagnostic center is trying to claim the deduction of the commission paid to the doctor. So friends, here again what High Court held was, first of all, Indian Medical Council regulations, ethics regulations 2012, 2002 came into picture, and as per the regulations, it is strictly prohibited for any monetary benefit to be obtained from a diagnostic center, meaning doctors cannot indulge in practice of obtaining any benefit, of obtaining commission or cash or monetary benefit by way of referral to other pharmaceutical sectors, or you can say part of the pharma industry. You cannot obtain any referral commission. So such obtaining of referral commission is strictly prohibited by Indian Medical Council regulations 2002. And in line with this, accordingly, section 37 explanation to section 37(1) prohibits such expenditure since it is illegal, since it is prohibited by law in force. Accordingly, the same can be denied under the provisions of the law. So friends, here you can see that such an act of referral or obtaining referral as commission is prohibited by the Indian Medical Council regulations, and accordingly the same won't be allowed as deduction as per explanation to section 37(1), right? And one of the contention of the SSC was that such a practice is a normal practice which is adopted by doctors, and accordingly the same cannot be referred to be as illegal because it is a common practice. What High Court held to this point was, since such a payment is against the public policy, wherein you are trying to refer a diagnostic center and obtaining referral fee, this will be against the public policy and such type of practice should not be encouraged, and accordingly, rightly as per Indian Medical Council regulations, this has been prohibited, and accordingly income tax law also doesn't accept such practice, discourages such practices, and accordingly deduction won't be eligible to the SSC. So friends, Punjab and Haryana High Court was not in favor of the diagnostic center, wherein deduction of the commission paid to the doctors, deduction of the referral fees paid to the doctors wasn't allowed as deduction to the diagnostic center. So friends, issue under consideration: can the commission paid to doctors by a diagnostic center for referring patients for diagnosis be allowed as business expenditure or not? High Court's observations: argument of the SSC that giving commission to the private doctors for referring the patients for various medical tests was a trade practice which could not be termed to be illegal. So contention of the SSC was that it was a trade practice and this should not be termed as illegal, and therefore the same cannot be disallowed under section 37(1). This was the contention of the SSC. Applying the rationale and considering the purpose of explanation to section 37(1), the SSC would not be entitled to deduction of payments made in contravention of the law. So anything in contravention of the law won't be allowed as deduction. Similarly, payments which are opposed to public policy, being in the nature of unlawful consideration, cannot also be claimed as deduction. So since it is opposed to public policy and the consideration received will be unlawful, and accordingly deduction won't be allowed. As per the Medical Council Professional Conduct Ethics Regulations 2002, no physician, as per the regulations, no physician shall give, solicit, receive, or offer to give, solicit, or receive any gift, gratuity, commission, or bonus in consideration of return for referring any patient for medical treatment. So again, as per the regulations, physicians are not allowed to accept, are not allowed to give any benefit, gratuity, commission, or bonus in consideration of the referral fees. High Court's decision: demanding as well as paying of such commission is bad in law. It is not a fair practice and is opposed to public policy and should be discouraged. Thus, the High Court held that the commission paid to doctors for referring patients for diagnosis is not allowable as business expenditure. So, High Court disallowed the expenditure as per explanation 1 to section 37(1) because such a referral fees, payment of such a referral fees is prohibited by Indian Medical Council regulations and accordingly will also be disallowed under the income tax law. So Punjab and Haryana High Court was not in favor of the SSC and expenditure of commission paid to the doctors was disallowed to the SSC. So friends, continuing with the next video. In this case, the apex court ruling, Berger Paints India Private Limited versus CIT 2017. The issue under consideration in this case was premium paid on subscribed share capital, whether the same can be included in the capital employed for the purpose of amortization under section 35D. So friends, as a background, section 35D is nothing but amortization of preliminary expenses incurred by the SSC before commencement of the business is allowed to the SSC as reduction in 1/5 of the portion in 5 equal annual installments starting from the year where business is commenced, and for the purpose of computing the deduction under section 35D, the deduction allowed to the SSC is 5% of the cost of the project or 5% of the capital employed of the SSC, whichever is higher. And for the purpose of capital employed, what is included in the definition of capital employed is issued share capital, debentures, and long-term borrowings. These three terms are to be included. And if you see, there is no specific mention of the word premium in it. securities premium is not included under issued share capital, or there is no specific mention that premium should be included for the purpose of computation of capital employed, and accordingly will be part of deduction, accordingly will be part of amortization under section 35D. So this was the background of section 35D, and in this case the SEC is claiming that premium received from the subscribers is to be included as capital employed and will be allowed as deduction, will be allowed as amortization in 5 equal annual installments as per section 35D. However, what Apex Court observed that the term premium, securities premium, is not included under the definition of capital employed if the intention of the legislation was to include securities premium under the definition of capital employed. The same would have been allowed, the same would have been mentioned in the definition of capital employed, and accordingly, since in absence of anything mentioned in the definition of capital employed, and considering the intention of the legislature, securities premium received by the SEC won't be allowed, won't be part of the capital employed for the purpose of amortization. Also, Apex Court made reference to the Companies Act, wherein the annual return form of the Companies Act provides a breakup of issued share capital. In that also, securities premium is not part of the breakup of the issued share capital. So, by providing reference to the Companies Act, Apex Court held that as per the annual return form as well, securities premium is not part of the issued share capital. So this could be one of the contention, one of the intentions of the lawmakers to bifurcate the amount received from issued share capital and the amount received from securities premium. Also, Section 78 of the Companies Act. As per Section 78 of the Companies Act, the SSC, the company is required to make separate account for securities premium account. So a separate account is required to be opened for depositing the amount of securities premium. So again, a bifurcation between proceeds received from issued share capital and proceeds received from securities premium. So not only the intention of the income tax lawmakers has been considered, but the intention while preparing the Companies Act law as well. The intention is clear that there should be a bifurcation between the proceeds received from issued share capital and securities premium, and accordingly, Apex Court held that the securities premium amount received won't be part of the capital employed and won't be allowed as amortization expenditure to the SSC. Friends, on your screen, issue under consideration: whether premium on subscribed share capital is capital employed in the business of the company under Section 35D to be eligible for deduction for amortization. Facts of the case: the SSC is a company engaged in the manufacture of paints. For the relevant assessment years, the SSC claimed deduction under Section 35D of a sum representing share premium as being a part of the capital employed. The said deduction was disallowed by the assessing officer. So the SSC included the share premium of part of the capital employed and claim amortization in 5 equal annual installments. Supreme Court's observations: share premium collected by the SSC on its subscribed issued share capital could not be part of capital employed in the business of the company for the purpose of Section 35D 3B. So Supreme Court has observed that this could not be part of the capital employed if it were the intention of the legislature to treat share premium as capital employed in the business of the company, it would have been explicitly mentioned. Fine. So intention of the legislature has been mentioned over here. Moreover, now the Companies Act reference. Moreover, column 3 of the form of annual return in part 2 of schedule 5 of Companies Act 1956, now Companies Act 19 and now Companies Act is 2013, under section 159 dealing with the capital structure of the company, provides the breakup of issued share capital which does not include share premium at the time of subscription. So the breakup of issued share capital does not include share premium at the time of subscription of the issued shares. Hence, in the absence of the reference in section 35D, share premium is not part of the capital employed, right? So two references, friends. One, the intention of the legislature. If the intention of the legislature was to specifically include the share premium in the definition of capital employed, that would have been done by the legislature, and the definition of capital employed includes only issued share capital, debentures plus long-term borrowings. It doesn't include securities premium received by the SSC. And when you refer Companies Act, annual return form, the breakup of issued share capital doesn't include securities premium. So two references. And the third reference, section 78 of the Companies Act, requires a company to treat the premium amount requires a company to transfer the premium amount to be kept in a separate account called securities premium account. So section 78 of the Companies Act, a separate account is to be opened for securities premium account for securities premium amount received. So again, a clear bifurcation between issued share capital proceeds and proceeds received from securities premium. So friends, this was the intention of the legislature, and this in reference to the Companies Act. So Supreme Court's decision in this case, affirming the decision of the High Court, the Supreme Court held that the SSC is not entitled to claim deduction in relation to the premium amount received from shareholders at the time of share subscription. So in line with the decision of High Court, Supreme Court held that SSC is not entitled to claim deduction in relation to the premium amount received. So friends, Supreme Court ruling was not in favor of Berger Paints India Limited, wherein the deduction of the securities premium to be included under the definition of capital employed was not allowed by the Supreme Court, and accordingly securities premium received won't be allowed as deduction under section 35D to the SSC. Now friends, moving on to the next case law, which is a Delhi High Court ruling in the case of Principal CID versus Reebok India Company 2018. In this case, the issue under consideration is where a loan is received by the SSC for business purposes and the same proceeds and part of the proceeds have been disbursed to third party for the purpose of business, then whether interest paid on the loan borrowed will be allowed as deduction to the SSC under section 36(1)(3) or not. So the loan proceeds have been received by the SSC and part of the proceeds are disbursed to a third party for the purpose of business or profession. So part of the proceeds were used for the purpose of business and part of the proceeds were disbursed to a third party which was again for the purpose of business or profession. Then whether the disbursement of loan, further disbursement of loan by the SSC, interest on it will be allowed as deduction to the SSC or not is the issue under consideration. And in this case, the assessing officer disallowed the expenses. The dispute resolution panel also disallowed the expenses. ITET The tribunal was in favor of the SSE that such expenditure, being for the purpose of business, should be allowed as expenditure, should be allowed as deduction to the SSE under section 36(1)(3). So assessing officer and DRP were not in favor of the SSE. Tribunal was in favor of the SSE, and here we are in High Court, wherein ruling is to be provided by the High Court, where department has challenged the view of tribunal. Before that, let's understand issue under consideration and facts of the case. Issue under consideration: loan proceeds paid to third party without charging any interest. So the loan was disbursed further by the SSC without charging any interest. This is also important. Can part of the interest paid by the SSC on unsecured loans taken be disallowed? So this is the issue under consideration, wherein the interest paid on such a loan will be disallowed or not in the hands of the SSC. Facts of the case: the SSC company has taken unsecured loans out of the total amount it had advanced part of the loan to third parties on which no interest was charged or received. Pursuant to this, for the relevant assessment year, the assessing officer proportionately disallowed under section 36(1)(3) the interest paid by the SSC on the grounds that it is not for the purpose of business or profession and not paid by the SSC, and accordingly won't be allowed as deduction. I mean, the interest is not received by the SSC, and accordingly deduction under section 36(1) should not be allowed to the SSC. The DRP dispute resolution panel affirmed the addition, opining that the assessing officer was empowered to examine if the expenditure, the assessing officer was empowered to examine if the expenditure incurred by the SSC met the rigors of business connection and commercial expediency. So here, DRP was not in favor of the SSC. Tribunal's view: the appellate tribunal opined that the proportionate interest genuinely paid on unsecured loans taken for business purpose could not be disallowed. The SSC had paid interest on capital borrowed for business purpose, and in the absence of any allegation and finding that the SSC had diverted unsecured loans for non-business purpose, no disallowance can be made. So, since the SSC has paid the interest which is for business purpose, and here the department is not counter arguing that the loan was used for non-business purposes, that the funds were diverted for non-business purposes, and accordingly deduction of interest should be allowed to the SSC. So tribunal's view was, since the interest has been paid by the SSC and the loan was used for the purpose of business or profession, the department has not argued, has not put forth any proof, any evidence that the funds were diverted for non-business purposes, for personal purposes, and accordingly such interest have met the conditions of section 36(1)(3), and accordingly interest deduction will be allowed to the SSC based on ITET, tribunal's view. And here the High Court's observations. High Court's observations was, they have relied on Supreme Court ruling in the case of SA Builders Limited, wherein two expressions have been analyzed: for the purpose of business or profession and for the purpose of earning interest income. So here, loan proceeds are taken for the purpose of business or profession. Part of the loan has been disbursed for the purpose of business or profession of the SSC. And what Supreme Court in the case of SA Builders observed, that held that there should not be any correlation between disbursing a loan and earning some income. If it can be established that interest has been paid that loan has been taken for business purpose and interest has been paid thereon, then expenditure under section 3613 cannot be denied to the SSC. It is not necessary that part of the loan which has been disbursed further, any interest income should be earned by the SSC for availing deduction under section 36(1). If the interest has been paid by the SSC and the loan has been utilized for the purpose of business or profession, then the same will be allowed to the SSC as deduction. This is what was held by Supreme Court in the case of SA Builders Limited. Also, the word commercial expediency has been analyzed. Commercial expediency is nothing but there should be a correlation between an activity and for the purpose of business or profession. If there is a correlation, then commercial expediency test has been passed and that particular expenditure, since it is related to the business or profession, will be allowed as deduction to the SSC. So friends, several terms have been analyzed by Supreme Court and the same has been held in favor of the SSC, wherein interest paid by the SSC for the purpose of loan which has been disbursed further has been allowed as deduction to the SSC under section 36(1)(3). We will read this further on your screen. High Court's observation: the High Court relied upon the Supreme Court ruling SA Builders Limited, which interpreted the expression for the purpose of business or profession in section 36(1)(3) as being wider in scope than the expression for the purpose of earning income, profit and gains. Accordingly, expenditure voluntarily incurred and meeting the commercial expediency test to be allowed as deduction. So friends, meaning if a transaction for claiming deduction under section 36(1)(3), the expression for the purpose of business or profession has an upper hand as compared to for the purpose of earning income. Meaning if the interest is paid by the SSC for the purpose of business, the same has to be allowed to the SSC. And commercial expediency test expression is of wide import and is satisfied once it is established that there was a connection and nexus between the interest paid and the SSC's business. So these words are quite important, wherein the expression commercial expediency test has been analyzed, and in the test, if it is concluded that the interest paid was related to the business of the SSC, the same has to be allowed to the SSC. The High Court observed that merely because non-interest bearing advances were given to third parties, that would not justify a finding that the test of commercial expediency was not satisfied. Interest-free advances were advanced to the parties connected with the business of the SSC. So here is the business connection where interest-free advances, the loan which has been disbursed further by the SSC, interest-free advances were advanced to the parties connected to the business of the SSC. So the connection of business. Money taken on loan was not diverted for non-business purpose and was not used for personal purpose. Right? The funds have been used for the purpose of business or profession. They haven't been diverted for non-business purpose. They haven't been used for personal purpose, and it has been diverted. Funds have been further disbursed to parties which are connected to the business of the SSC. Accordingly, a business connection is there. Interest has been paid, and accordingly commercial expediency test has been passed, and deduction under section 36(1)(3) will be allowed. Therefore, according to section 36(1)(3), interest paid on capital borrowed for the purpose of business had to be allowed as a deduction. The word had to be allowed only because the commercial expediency test has been passed by the SSC. Further, the High Court opined that the revenue cannot assume the role and occupy the armchair of a businessman to decide whether expenditure was reasonable. The revenue cannot look at the matter from its own standpoint, but the opinion and decision of the businessman on business expediency should also be considered by the SSC. Right? High Court held that deduction for interest paid on unsecured loans has to be allowed under Section 36(1)(3), where commercial expediency test is satisfied even though part of the unsecured loan was advanced to third parties without charging interest. So High Court was in favor of the SSC. Similar point of view was of tribunal, and accordingly deduction of the interest paid on a loan, on a proportionate loan which has been disbursed further by the SSC for the purpose of business, will be allowed to the SSC because the commercial expediency test has been satisfied by the SSC, meaning interest has been paid by the SSC and the same loan proceeds have been utilized for the purpose of business, and accordingly deduction under Section 36(1)(3) had to be allowed. It cannot be disallowed. Now friends, let's start with the next case law, which is delivered by Gujarat High Court in the case of CIT versus Gujarat State Road Transport Corporation 2014. In this case, the issue under consideration is where employees' contribution to Provident Fund and ESI, Employees State Insurance, has been paid by the SSC before the due date of filing of return of income, but after the due date of relevant Provident Fund Act and ESI Act, then whether deduction of the employee's contribution will be allowed to the SSC or not. So contribution, just to give you background, employee's contribution to Provident Fund, for example, has to be taken as income of the employer once it is deducted from employee's salary. So as a process, employer pays salary to the employee which is net of Provident Fund. So employee's contribution is deducted by the employer. Such employee's contribution will be treated as an income under Section 224 of the employer till the time the same is deposited in the trust, in the private trust you can say, or with the PF authorities. So till the time the employer deposits the amount of the employee's contribution, till the time it is deposited, it will be treated as income of the SSC employer, and once the amount is deposited, a deduction can be claimed under Section 36(1)(5)(a) by the employer. And one of the sentence in the Section 36(1)(5)(a) is that the deduction should be, the contribution should be deposited by the employer on or before the due date. So here due date definition, due date term has been analyzed in two ways: whether the due date is filing of return of income or whether the due date is the relevant account, relevant Provident Fund account or ESI account. This has been a matter of litigation for quite some time now, wherein there are favorable opinions as well as unfavorable opinions, and we have a High Court ruling, Gujarat High Court ruling on a similar issue, wherein whether deduction will be allowed to the SSC or not if the contribution, if the employee's contribution is paid on or before the due date of filing of return of income, but after the due date of Provident Fund account. Let's go to the issue under consideration. Can employees' contribution to Provident Fund and employees' state insurance be allowed as deduction where the SSC employer had not remitted the same on or before the due date under the relevant act, but remitted the same on or before the due date of filing of return of income? So the term due date has to be analyzed. Facts of the case: the SSC collected employees' contribution to Provident Fund and ESI which were remitted after the due date under the relevant act but before the due date of filing of return of income. The assessing authority held that the amount collected by way of employees' contribution to PF and ESI are income under Section 224(10), and the remittance is governed by Section 36(1)(5)(a). The time limit prescribed for remitting the contribution is the due date prescribed under the Provident Funds Act, Employees State Insurance Act, rule, order or notification issued thereunder, or under any standing order, award, contract or service, or otherwise. In a nutshell, the assessing authority concluded that due date is the due date under the relevant act, which is Provident Fund Act, ESI Act. This was held by assessing authority. What High Court observed was there is no correlation between Section 43 and Section 36(1)(5)(a). Section 43(b) says if you make the payment of the relevant expenditure of the prescribed expenditure, then deduction will be allowed to the assessee. Meaning if you pay the bonus, it will be allowed on the payment basis. If you pay employer's contribution to PF, then it will be allowed as deduction to the assessee. If taxes are paid, if the taxes are indeed paid by the assessee on or before the due date of filing of return of income, then deduction of expenses will be allowed to the assessee. So on payment basis and on or before the due date of filing of return of income, if assessee has satisfied this condition, then 43(b) can be invoked and deduction can be allowed. However, what High Court observed that there is no correlation in this case between Section 43(b) and Section 36(1)(5)(a), only because the nature of income, the nature of contribution is such that it is first treated as income of the assessee. The employee's contribution is treated as income of the assessee, and thereafter a deduction is available based on satisfaction of certain condition, and condition is you should make the payment of the employee's contribution on or before the due date of relevant act. So since it is an income, it won't qualify as prescribed expenditure under Section 43(b). This is the observation of High Court. It may have been allowed, the employer's contribution, if we see, it is allowed as deduction if it has been paid on or before the due date of filing of return of income, only because it is only in the nature of expenditure which has been incurred by the assessee. But here, in the case of employee's contribution, it is first treated as expenditure, it is first treated as revenue, income of the assessee, employer, and then it is allowed as deduction. So, High Court denied any link, any correlation between Section 43(b) and deduction of employees' contribution to Provident Fund, and accordingly, the expenditure, the employees' contribution deduction wasn't allowed to the assessee, only because the payment was made after the due date of the relevant act. So, friends, High Court's observations. The High Court noted that Section 43(b) pertaining to employer's contribution cannot be applied with respect to employee's contribution, which is governed by Section 36(1)(5)(a). So, Section 43(b) pertaining to employer's contribution cannot be linked with employee's contribution. So far as the employee's contribution is concerned, the explanation to Section 36(1)(5)(a) continues to remain in the statute, and there is no provision for applying the extended time limit provided under Section 43(b) for remittance of employees' contribution. So the extended time limit, which is up to the due date of filing of return of income, cannot be linked with the employee's contribution. The amount of employees' contribution to PF and ESI is an income upon recovery from salary, and its remittance within the due date as specified in Section 36(1)(5)(a) makes it eligible for deduction. So specified conditions has to be satisfied by the assessee for claiming deduction. Employees' contribution recovered by the employer is not eligible for extended time limit up to the due date of filing of return, which is available under Section 43(b) in the case of employees cut start, in the case of employer's own contribution. So friends, 43B can be linked to employer's contribution, wherein the due date of deposit of employer's contribution is up to the due date of filing of return of income. However, the due date of depositing the employee's contribution will continue to remain to be due date under the relevant act as per section 36(1)(5)(a). So, difference between employer's contribution and employee's contribution, friends. High Court held that the delayed remittance of employee's contribution beyond the due date prescribed in 36(1)(5)(a) is not deductible by computing the business income, even though such remittance has been made before the due date of filing of return of income. So, the ruling was not in favor of the SSC, wherein the deduction of the employee's contribution was not allowed to the SSC. A contrary view was expressed by Uttarakhand High Court in the case of CIT versus Kicha Sugar Company Limited 2013, 356 ITR 351. Friends, as we have discussed, that this particular point has been a matter of litigation over the years, wherein Section 36(1)(5)(a) says that the employee's contribution should be deposited on or before the due date. However, there is no further clarification that the due date is from return of filing of return of income, that the due date is filing of return of income or the due date under the relevant act. And accordingly, several case laws are there, either in favorable of the SSC or not in favorable of the SSC. Here, the case law that we discussed was not in favor of the SSC, and there has been contrary view as well, wherein employees' contribution has been allowed as deduction where the contribution has been deposited on or before the filing of return of income, which was in the case of Uttarakhand High Court in the case of CIT versus Kicha Sugar Limited. So, in this case, Gujarat High Court has ruled against the SSC, and deduction of the employee's contribution was not allowed to the SSC, only because the contribution was made after the due date of the relevant act. Now friends, moving on to the next case law, which is in the case of Apex Court ruling, Shashan Chemicals and Drugs Limited versus CIT 2016, which is a Supreme Court case law, Supreme Court ruling. Here the issue under consideration is whether payment of bonus by the employee, by the payment of bonus to the employee after the due date, which is before, not after the due date, which is before the due date of filing of return of income, can be allowed as deduction to the SSC, where the funds have been transferred to the trust before making payment to the employee. So friends, 36(1)(2), if bonus is paid by the SSC employer to the employee, deduction will be allowed under section 36(1)(2), and we have to link it with section 43B, wherein if the payment of bonus has been done on or before the due date of filing of return of income, then such payment of bonus will be allowed as deduction to the SSC employer. If not, then the same will be disallowed under section 40A(9). And the issue under consideration is, before making payment to the employee, the payment has been made. The bonus payment has been made by the employer on or before the due date of filing of return of income. However, the funds were initially parked in a trust. So whether, since the funds have been routed through trust, the deduction can be denied or not is the issue under consideration. Right? So the facts of the case, friend. Here, why the payment was routed through trust was, in this specific case, there was a dispute between employer and the employees union, between the trade union and the employees and the employer. There was a dispute regarding the payment of bonus, regarding the quantum of bonus. So the employees were not in agreement with the bonus payment, and accordingly they didn't take the bonus payment. I mean, the payment was made in cash, you can say, and they didn't want to accept the payment of the bonus paid by the employer. There was a dispute on the quantum of the bonus between the employee and the employer. And to be in compliant, just that the employer is in compliant with section 43B for the purpose of deduction, what employer did was they parked the funds in the trust and considering them as payment to the employee, they claim deduction under section 43B. And thereafter, there is another part that, you know, the dispute was resolved immediately with the employees and the bonus amount was paid to the employees from the trust. So the assessing officer is of the contention that such bonus amount which has been routed through trust should not be allowed as deduction under section 3612. Assessing officer denied such a deduction. And appellate tribunal, CIT appeals and appellate tribunal were in favor of the SSC, in which the payment of bonus was allowed to the SSC as deduction. However, High Court was not in favor of the SSC and they disallowed the expenditure of bonus. So now SSC has challenged High Court ruling and we are in front of Supreme Court. Supreme Court held that since the payment has been made on or before the due date, since the payment of bonus has been made by the employer to the employee on or before the due date, there will be no question of disallowance under section 40A9. Meaning 3612 says the payment should be made before the due date of filing of return of income. Here, as per the facts of the case, effectively the payment has been made to the employee on or before the due date. So conditions of section 36(1) to read with section 43B has been satisfied by the employer. So there should be no question of not allowing such deduction. I mean, they are not on the part that funds have been routed through trust. It doesn't matter. As per Supreme Court, it doesn't matter whether funds have been routed through trust or not. If ultimately the payment has been made to the employee on or before the due date, then deduction should be allowed to the SSC under section 3612. This was held by Supreme Court. So friends, on your screen, issue under consideration: in a case where payment of bonus due to employees is paid to a trust and such amount is subsequently paid to the employees before the stipulated due date, would the same be allowable under section 3612? Computing the business income is the issue under consideration. Facts of the case: the SSC company and its employees union had a dispute as regard the quantum of bonus, which led to the labor unrest. Due to this reason, the workers refused to accept the bonus offered to them. However, in order to comply with the requirement of section 43B, that is, deduction in respect of bonus will be allowed only if the payment has been made, the SSC made payment to a trust. The dispute with the workers was settled well in time and the bonus was paid to the workers on the very next day of deposit of the same amount in the trust, and that too before the due date by which such payment is supposed to be made in order to claim deduction under section 36. So the payment was ultimately made before the due date of filing of return of income. The assessing officer, however, took a view that since the payment was made from the trust and not by the SSC directly, since the payment was made from the trust and not made by the SSC directly, it is not allowable in view of the provisions of section 40A9. Right? So assessing officer has denied deduction as per section 40A9 to the SSC. Appellate authorities' views, the Commissioner appeals, CIT appeals, and the appellate tribunal did not accept the assessing officer's view, but the High Court concurred with the assessing officer view and denied deduction under section 36(1)(2) to the SSC. So CIT appeals and tribunal ITAT were in favor of the SSC, However, High Court was in favor of the assessing officer and SSC has challenged the judgment of High Court, and the Supreme Court is in picture now. Section 36(1) contains various kinds of expenses which are allowable as deduction while computing the business income. The amount paid by way of bonus is one such expenditure which is allowable as deduction under Section 36(1)(2). It also held that the restriction contained in Section 43B or Section 40A(9) does not come in the way of SSC's claim, since the bonus was ultimately paid to the employees before the due date as per statutory requirement. So it's quite simple that ultimately, where the payment has been done on or before the due date, then the question of disallowance under Section 43B or under Section 40A(9), such question doesn't arise at all, since the payment has been made on or before the due date. If the payment was made after the due date, then there would have been a point of contention wherein the payment to trust can be termed as payment to the employees or not, only because there was a dispute between employer and employee, and out of such dispute, since the employees were not accepting the payment but the employer was ready to make the payment, the employer, in order to be compliant the employer, in order to be compliant with Section 43B, had made the payment to trust. It wasn't made to the employee, but the payment was made to trust. And if it can be established, the facts in this case are missing, wherein whether the trust is irrevocable trust or not, meaning the funds cannot be extracted back by the employer from the trust. Right? If the payment at all would have been made after the due date, then such point of contention would have come in picture, that whether payment to trust can be termed as payment to employees in specific circumstances. So this could have been a point of contention, but however here the payment has been made on or before the due date only. So Section 43B or Section 40A(9) in that case won't be coming into picture at all. So the Supreme Court held that since the payment has been made on or before the due date, the payment will be allowed as deduction to the SSC. Therefore, the payment in respect of bonus is allowable as deduction, as there is no dispute at all that the amount was paid by the SSC to its employees before the due date by which such payment is supposed to be made in order to claim deduction under Section 36(1)(2). And the concept of and the principle of substance over form is important over here, wherein the beneficial ownership is with the employee only. Just that the funds has been transferred to the trust, which you can say is the legal owner. So friends, concept of beneficial ownership and legal ownership is very much important for substance over form principle, wherein the funds had been transferred to trust. We are taking a hypothetical example. We are assuming that payment has not been made before the due date. The bonus payment has not been made to the employees before the due date of filing of return of income. In that scenario, what would have happened was the payment has been made to trust and the trust is yet to make the payment to employees. So whether deduction can be availed under Section 36(1)(2) would have been the question, would have been the issue. In that case, substance over form principle would have been used, wherein beneficial ownership and legal ownership. Here you can observe that beneficial ownership remains with the employee. Trust would have been a legal owner only, wherein they are just holding the funds on behalf of the employee. It's just that whenever the dispute is settled between the employer and employee, the trust would have transferred the amount to the beneficial owner, to the employees in this case. So as far as my opinion is concerned, even if the payment of the bonus was made after the due date of filing of return of income, deduction would have been allowed to the SSC employer only because the funds were parked in a irrevocable trust, and considering and applying the substance over form principle, the amount would have been allowed as deduction to the SSC under Section 43B. So friends, High Court ruling was in favor of the SSC, wherein payment of bonus on or before the due date of filing of return of income was allowed as deduction to the SSC, even if the funds were routed through trust. So friends, next case law is a Delhi High Court case law, CIT versus Yamaha Motor India Private Limited 2010. In this case, the issue under consideration is whether depreciation is allowable on a discarded asset, a machinery which is obsolete, which is redundant, and accordingly has been discarded by the SSC, whether depreciation can be continued to be allowed under section 32 on such a discarded asset. So here discarded means, so the issue under consideration is whether depreciation on such an asset will be allowed or not, and second issue is whether such a discarded asset, monies payable from it, should be deducted from the written down value as per section 43(6) or not. So two issues, whether depreciation should be allowed on the discarded asset, and second, whether monies payable should be deducted from the written down value of such a discarded asset or not. So friends, facts of the case are, after understanding the issue under consideration, the facts of the case are the SSC is in the business of motor vehicle and it uses several machineries under the same block. And out of the, let's say, 20 machinery, one of the machinery was absolute, was of no use, and accordingly it was discarded by the SSC. Here, the word discarded would mean it hasn't been sold or no scrap value has been derived. It's only that the SSC is no more using the asset only because it is obsolete. So here SSC is no more using the asset, it is just discarded but not sold, nor any scrap value has been derived from the asset. And SSC has filed its return of income claiming total depreciation, meaning 20 machineries written down value over the years, let's say 1 lakh, let's say 1 crore, and when the asset was discarded, nothing has been deducted from the written down value. On 1 crore amount, depreciation was claimed by the SSC, and accordingly, total depreciation was claimed by the SSC and return of income was filed. However, the assessing officer denied total depreciation, and he was from the perspective that monies payable should be calculated, the sale value of the absolute asset which is discarded should be calculated and should be deducted from the written down value, and on the net written down value depreciation should be allowed to the SSC and not on the gross written down value amount. So friends, issue under consideration, facts of the case: allowance of depreciation in the case of discarding of an absolute asset, and whether merely discarding an absolute machinery which is physically available means it is not sold will attract the expression monies payable appearing in section 43(6) so as to deduct its value from written down value of block of asset. The first issue under consideration is allowance of depreciation, and second issue under consideration is whether asset discarded should come under the expression monies payable or not. Facts of the case: one of the machineries used by the SSC for the purpose of business had become obsolete and was discarded by the SSC. SSC filed its return of income claiming total depreciation including the depreciation on the machinery item discarded. The AO disallowed the claim of depreciation on the discarded asset during the course of scrutiny assessment. So the AO disallowed the claim of depreciation of the SSC. Herein, the High Court, which is Delhi High Court, the Delhi High Court observed that Section 32 provides depreciation. Now, the basic condition is it should be used for the purpose of business or profession. If the asset is used for the purpose of business, amongst other things, that is, he should be the owner of the SSC, and so on. If the asset is used for the purpose of business, then deduction of depreciation cannot be denied. And here, High Court has stated that for the purpose of discarded asset, the usage of asset for the purpose of business in the previous year should be interpreted as using not only for the previous year but also for the preceding previous years. Meaning, if the discarded asset was continued to be used in the preceding years, then deduction under section 32 cannot be denied. This was one of the interpretation of High Court, wherein for discarded asset, the interpretation, the section, the provisions of the section should be read in a way that usage of the asset for the purpose of business would include usage during the preceding previous years as well. And as per the facts of the case, SSC had continued to use the asset before discarding it. This was answer to the first issue under consideration. Second pointer was for monies payable. For the monies payable, High Court said that the asset wasn't sold by the SSC at all. It was only discarded. It wasn't physically used by the SSC. That's it. In fact, in actual, the SSC didn't sold the asset. There was no question of any sale value being deducted from the written down value. So, to answer the second issue, the sale value, in fact, the asset in fact was not sold by the SSC. Accordingly, no sales value has been derived, and there will be no question of computing the hypothetical sales value in this case. This is what has been said by the High Court in this particular case law. So, friends, on your screen, I could observe that one of the conditions for claim of depreciation under section 32 is that the eligible asset must have been put to use for the purpose of business or profession. The expression used for the purpose of business in section 32, when used in respect of discarded machinery, the expression used for the purpose of business under section 32 when used in respect of discarded machinery would mean the use in the business not only in the relevant previous year but also in the earlier previous year. Very much important, wherein by interpreting, you can observe that by interpreting bare section of the act, you might have interpreted that it should be used in the previous year. The first question that will come in your mind is, it hasn't been used in the previous year, right? So active use and passive use comes into picture. As per the law, through interpretation, it is that passive use includes active use, meaning even if the asset has not been used for the purpose of business or profession, certain assets will be assumed to be used for the purpose of business during the relevant year. For example, fire extinguishers. They are available for use, but actually they cannot be used, right? So, as per the Dare Act section, in layman terms, in strict terms, it should be used for the purpose of business or profession during the previous year. However, we have to interpret what is the intention of the legislation. Generally, the intention of the legislation you may get by reading the memorandum at the time of introduction of the provisions. The reason behind the introduction of the provisions are mentioned under the memorandum of association of the not association memorandum, wherein it has been issued along with the Finance Act. The reason for issuing, if you want to understand, read memorandum, which is issued along with the finance bill. You will get the same on the income tax website. So friends, as we have understood that interpretation in layman terms, you would have concluded that the asset should be strictly used during the previous year. However, we have to take into consideration the intention of the legislature, and the intention of the legislature is even the passive use will be an active use. Also, in terms of discarded asset, the usage in the preceding previous year would be deemed to be usage in the relevant previous year as well. Accordingly, asset depreciation on such discarded asset will be allowed to the SSC, right? Very important. I mean, this will help you how to interpret terms over here. By reading the Bare Act, you will come to the conclusion that it shouldn't be allowed. However, you will find several case laws. If the wordings of the provisions, there is any ambiguity in the wordings of the provisions, then there is bound to be that you will find some or the other case law. So always, as we have read in chapter 1, that the provisions of the Act in the Income Tax Act are to be read along with circulars, along with notifications, along with case laws, along with income tax rules. So there are several other documents which must be referred to arrive at the intention of the law. And on day-to-day basis, there are number of case laws being delivered, number of rulings being delivered on the Income Tax Act itself at various levels at CIT appeals, ITAT, High Court, Supreme Court. So to determine the intention of the law, you will have to read case laws, and there will be there may be, if the litigation, if the point of matter of litigation is cannot be settled, there might be a possibility that it may not be able to, I mean, the court of law may not be able to settle a matter of litigation wherein favorable opinions will be there as well as unfavorable opinions will be there. So it will be up to you how to interpret the law. I mean, how many cases are in favorable of the SSC while deciding on a particular transaction. Let's say, for example, in this case, you would have been a consultant and the SSC is asking you how to move ahead in this case, wherein depreciation will be allowed or not to the SSC. It is to be determined as a consultant by you. Then, how will you move forward in this case? So, you will have to read the bare provisions of the Act. You will have to read the case laws which are there, whether favorable, whether unfavorable. There might be a scenario that you get favorable as well as unfavorable case laws. In that case, whether client is ready to take, that risk in case, there are unfavorable opinions, whether the client is ready to take that risk to go ahead and take the benefit or not. So in practical scenario, if you see, the picture is whole lot of different, right? Wherein practically in this particular scenario, but start in this particular scenario, you would have to interpret the provisions yourself. You will have to interpret relevant circulars, notifications, case laws, and after reading all this, you will have to come to a conclusion. And at times, decision may have to be left to the client to take whether to go ahead with the benefit or not, where there are case laws which are favorable as well as unfavorable. So, friends, coming back to the point of interpretation of law, as far as the interpretation of law is concerned, in this case, depreciation under Section 32 will be allowed to the SSC because for discarded asset, the term used for the purpose of business or profession should be interpreted as not only being having used for the relevant previous year, but if an asset has been used in the preceding previous year, then deduction under Section 32 will be allowed to the SSC. On your screen, the discarded machinery may not actually be used in the relevant previous year, but depreciation can be claimed as long as it was used for the purpose of business in the earlier years, provided the block continues to exist in the relevant previous year. Obviously, all the assets of the particular block of assets shouldn't have been sold. If they are sold, then depreciation won't be eligible. So, if only one of the asset has been sold out of the 20 block of assets, out of the 20 assets, for example, then depreciation can be claimed on the discarded asset. Therefore, the condition for claiming depreciation in respect of the discarded machine would be satisfied if it was used in the earlier previous years for the business for the purpose of section 43.6. So friends, this was answer regarding first issue, which was allowance of depreciation, whether it can be claimed in case of discarded asset as well. And the answer is yes. On the discarded asset, depreciation can be claimed, provided they have been used in the preceding previous year by the SSC and for the purpose of business or profession. Second issue, monies payable. Since the asset wasn't sold at all, then the question of monies payable won't arrive. And as per High Court, you cannot value a discarded asset. A market value cannot be derived. A notional value cannot be derived of the asset. And accordingly, by deriving notional value, you are deducting the same from written down value. That won't be possible. For the purpose of section 43.6, monies payable means the sale price in case of sale, or the insurance, salvage, or compensation monies payable in respect of the asset. In this case, the machinery has not been sold as machinery or scrap or disposed of, and it continues to exist. Right? So in this case, machinery has not been sold as machinery or scrap or disposed of, and it continues to exist. It is just that it has been absolute, it cannot be used, and it has been discarded from usage. However, physically it is present in company's factory. Hence, there is no monies payable in this case, which alone is deductible while computing the WDV of the block to which it belongs. So, in absence of any sales value, nothing can be deducted. High Court held that action of the assessing officer in disallowing the depreciation claim attributable to the discarded machinery on the ground that the same was not put to use in the relevant previous year is invalid, since the said machinery was put to use in the earlier previous year. So, very much important. Wherein same was not put to use in the relevant previous year is invalid since the same has been used in the preceding previous year. Accordingly, depreciation on the discarded machinery will be allowed to the SSC in this case, and the High Court ruling, the Delhi High Court ruling in this case was in favor of the SSC, wherein the depreciation claim under section 32 was allowed to the SSC for discarded asset since the asset was used in the earlier previous year, and the question of monies payable doesn't arise in this case because the asset wasn't sold at all. So friends, the next case law is the Supreme Court case law in the case of Taparia Tools Limited versus GCIT 2015 372 ITR 605. Supreme Court. Issue under consideration is whether debentures, the maturity period of which is 5 years, and wherein SSC company has agreed to make the payment of interest upfront of the 5 years to the debenture holder. So here SSC has entered into arrangement with, has entered into agreement with the debenture holders wherein the debenture issue, they will make the interest payment upfront in the first year itself, and the maturity period is 5 years. It doesn't matter, we will make the payment, the SSC company will make the payment in the first year itself of all the 5 years. So in this case, whether the issue under consideration is whether interest of the entire 5 years should be allowed to the SSC in the first year itself, or it should be amortized over a period of 5 years, right? So this is the issue under consideration, and the facts of the case are interest has indeed been paid by the company in the first year itself and in the books of accounts, and while filing the return of income they have claimed entire interest paid in the return of income. However, in the books of accounts, what they have done is they have claimed deduction of interest in 5 equal annual installments. So you can say there is deferment, there is difference in treatment of interest in the case of return of income and in the case of books of accounts of the SSC, wherein in the return of income entire amount paid has been claimed as deduction of the 5 years, and in the books of accounts 5 equal annual installments has been considered by the SSC. So whether in this case deduction should be allowed 100% or on deferment basis is the issue under consideration. And we have also understood the facts of the case on the screen. Issue under consideration in a case where debentures are issued with maturity at the end of the 5 years and the debenture holders are given an option of upfront payment of interest in the first year itself. Upfront payment in the first year itself, can the entire upfront interest paid be claimed as deduction by the company in the first year, or should the same be deferred over a period of 5 years is the issue under consideration. Facts of the case: SSC issued debentures which were to be matured at the end of 5 years. The debenture holders were given an option of one-time upfront payment of interest, which was to be immediately paid by the company. As per the option exercised by the debenture holders, company paid interest upfront to them in the first year itself, and the same was claimed as deduction in the return of income. The company paid and claimed deduction of the entire interest in the return of income, but in the accounts, in the books of accounts, the interest expenditure was shown as deferred expenditure to be written off over a period of 5 years. So difference in treatment as per the books of accounts and in the return of income. During the course of assessment, the assessing officer spread the upfront interest paid over a period of 5-year term of debentures and allowed only 1/5 of the amount. So the assessing officer denied 100% deduction to the interest in the first year itself, and deferment of the interest was allowed by the assessing officer. The Supreme Court in this case observed that the amount of interest paid by the SSC as per section 3613 was for the purpose of business or profession, and accordingly interest on paid basis as per section 43B will be allowed as deduction. So if you see section 3613, the conditions are satisfied, as well as section 43B, where based on actual payment you have claimed deduction, that also is satisfied. So the upfront payment of interest should be allowed to the SSC as per income tax law. And books of accounts where deferment of expenditure has been done should not be relevant in this case. So what Supreme Court is trying to say is, you do not see books of accounts in this case. You see the income tax law. You see whether conditions of section 3613 read with section 43B have been satisfied or not. If the same has been satisfied and the SSC is compliant in terms of income tax law, then you cannot deny or you cannot defer the expenditure based on the treatment in the books of accounts. The company has followed the same treatment in the books of accounts in compliant with the company's law, in compliant with the practices adopted as per the company's act, and that cannot be brought in picture while seeing deduction under the income tax law. So friends, Supreme Court has bifurcated the provisions as per income tax law and provisions as per the Companies Act, wherein the conditions of the Income Tax Act are satisfied by the SSC, then the deduction of the interest amount will continue to be available to the SSC. So Supreme Court held in favor of the SSC, wherein 100% deduction was allowed to the SSC in the first year itself, as per section 3613 read with 43B. On your screen, under section 3613, the amount of interest paid in respect of capital borrowed for the purpose of business is allowable as deduction. The moment the option for upfront payment was exercised by the subscriber, the liability of the SSC to make the payment in that year had arisen. Fine. Not only had the liability arisen in the previous year in question, it was even quantified and discharged as well in that year. So once the SSC has, once the debenture holders have agreed for upfront payment, so there was liability has arisen for the SSC company, and the same was quantified and paid by the SSC company to the debenture holders. Supreme Court held that when the deduction of the entire upfront payment of interest is allowable as per Income Tax Act, the fact that a different treatment was given in the books of accounts could not be a factor, which would bar the company from claiming the entire expenditure as deduction. So, a clear bifurcation between Income Tax Act and other provisions of other law. Accordingly, the action of the assessing officer in spreading the upfront interest paid over the 5-year term of debentures and restricting the deduction to one-fifth of the upfront interest paid is not correct. So, the action of the assessing officer in deferment of interest paid was not correct as per the Supreme Court, and accordingly, the company is eligible to claim the entire amount of interest paid upfront as deduction under section 36(1)(3). Right? So the Supreme Court in this case, in the case of Taparia Tools Limited, was in favor of the SSC, wherein the interest deduction was allowed at 100% to the SSC in the first year itself. And the relevant sections are 36(1)(3). Read with section 43B. Moving on to the next case law. In the case of the next case law is related to Delhi High Court in the case of Gujarat Guardian Limited, CIT versus Gujarat Guardian Limited 2009. Your friends, the issue under consideration is whether the company has taken a loan in this case and there was a prepayment of principal amount by the company. So, whether such prepayment of the interest amount, the principal amount, the EMI would also include the interest amount. So, whether such interest amount prepayment made by the SSC will be allowed as deduction to the SSC or not is the issue under consideration, right? So you can say practically the SSC might have additional funds at their disposal, and to reduce the rate of interest, to reduce the future liability, they have made a prepayment of part of the loan upfront, which includes the interest amount as well. So whether deduction of interest in such cases will be allowed under section 36(1)(3) or not, meaning the prepayment of interest done by the SSC, whether a deduction can be allowed to the SSC or not is the relevant question. So here, practically if you see 36(1)(3), interest loan has been considered for the purpose of business or profession. That condition is satisfied. Interest has been paid as per section 36(1)(3). That condition is satisfied. 43B, you have paid the amount on or before the due date. Even that condition is satisfied. Accordingly, interest deduction will be allowed. And whether, the question over here is whether interest, under the definition of interest, such prepayment can be included or not, meaning what generally whatever is due you pay. However, whether such prepayment of interest wherein you have paid, let's take an example that you have paid interest amount for 5 years, so whether the interest amount, prepayment of such interest amount will be allowed as deduction under section 36(1)(3) or not is the question. So we will have to analyze whether prepayment of such interest falls under the definition of interest or not as per section 2 clause 28. So section 2 contains the definitions of the terms used in the Income Tax Act, and definition of interest under section 2 clause 28 includes the prepayment as well. If you see section 228, it includes the repayment of interest as well. Accordingly, joint reading of section 228, second section being 36(1)(3), third section being 43B, if they are read together, then combined reading of these sections leads to a conclusion that interest amount paid by the SSC for the purpose of prepayment of the loan will be allowed as deduction to the SSC under section 36(1)(3). Read with 43B, read with section 2 clause 28 of the Income Tax Act 1961. So friends, issue under consideration whether lump sum prepayment premium for restructuring the loan and reducing its rate of interest can be claimed as deduction or not entirely in the year of payment, or the same is required to be amortized over the tenure of the restructured loan. So whether 100% or whether entirely interest should be allowed or it should be amortized over the tenure of the restructured loan, right? Facts of the case: SSC paid to a public financial institution lump sum prepayment premium for restructuring its debts and reducing the rate of interest. It claimed the entire sum as business expenditure in the year of payment itself. The assessing officer, however, held that the prepayment premium should be amortized over the tenure of the restructured loan. I could observe that SSC companies' claim for deduction has to be allowed in one lump sum, keeping in view the provisions of section 43B(d). So the first section has come into picture. The section provides that any sum payable by the SSC as interest on any loan borrowing from any financial institution shall be allowed to the SSC in the year in which the payment is made. In the year of payment, as per section 43B, in the year of payment, the interest reduction will be available irrespective of the periods in which the liability to pay such sum is incurred by the SSC according to the method of accounting regularly followed by the SSC. So, irrespective of the period in which liability is incurred, it doesn't matter whether liability is incurred or not as per books of accounts regularly maintained by the SSC. It doesn't matter whether liability is incurred or not. If the amount has been paid, it will be allowed as deduction as per section 43B. And if you see note as per section 3613, 3613 provides for deduction of interest paid in respect of capital borrowed for the purpose of business. Section 228A defines interest and it includes any other charge in respect of monies borrowed or debt incurred. Section 43B provides for certain deduction to be allowed on actual payment. So here, if we do a combined reading of these three sections, it can be concluded that prepayment premium represents interest. It is included under the definition of 228A. Such interest is deductible as business expenditure as per 3613, and such interest is deductible in one lump sum or actual payment as per section 43B(d). Accordingly, the High Court held that the High Court concurred with the tribunal's view supporting the SSC that in terms of section 3613 read with section 228A, the deduction for prepayment premium was allowable to the SSC. Since there was no dispute that the prepayment premium was nothing but interest and that it was paid to a public financial institution, the court held that in terms of section 43B, the SSC's claim for deduction has to be allowed in the year in which payment has been actually made by the SSC. Accordingly, the contention of assessing officer is incorrect. So friends, interplay between three sections over here. Section 3613, which provides deduction of interest amount on a loan which has been borrowed for the purpose of business. Section 43B, if we are making an actual payment of the expenditure, a deduction will be allowed to you. It doesn't matter whether the liability has incurred or not. It doesn't matter what you have followed in your books of accounts as a method of accounting regularly followed by you as an SSC. And the third section is 228A, wherein it can be concluded that prepayment done by the SSC in this case can be included under the definition of interest, right? So friends, the High Court ruling Delhi High Court ruling in the case of Gujarat Guardian Limited was in favor of the SSC, wherein 100% deduction was allowed to the SSC under section 3613. in which the prepayment premium paid by the SSC was allowed as deduction in the year of payment. Friends, moving on to the next case law, which has been delivered by Delhi High Court in the case of CIT versus in Silico Limited. In this case, the issue under consideration is whether depreciation is eligible on emergency spares on a standby equipments if they haven't been actually used. So there are emergency spares which are part of a plant of machinery. This has to be decided whether they are part of the plant of machinery or not. These are emergency spares and they can be used in conjunction with, along with the plant and machinery, along with the main plant and machinery. And such an emergency spares are required to be used only in specific circumstances. So during the concerned previous year, such emergency spares haven't been used. So whether on such spares which haven't been used during the relevant previous year, whether depreciation can be allowed or not is the issue under consideration. So friends, while discussing depreciation, section 32, we had understood the concept of active use and passive use, wherein, if you remember, we had taken an example of a standby equipment of fire extinguisher, which is available for use and it is not used unless and until there is a specific circumstance. Fine. So, on such a standby equipment, depreciation will be allowed, will continue to be allowed to the SSC even if the asset is not actually used during the previous year. However, if the asset is kept ready for use, then depreciation will be allowed. And accordingly, the active usage and the passive usage concept was discussed, wherein even the passive use of the asset will be considered for the purpose of depreciation under section 32. Similarly, you can apply that similar concept which was applied for a standby equipment can be applied in this case as well, wherein the emergency spares, if it is capitalized in the books of accounts, if the emergency spares can be held to be an integral part of the plant and machinery, if they are integral part of the plant and machinery, if they are capitalized in the books of accounts, then depreciation cannot be denied. Ideally, depreciation should not be denied on the emergency spares. Correct, friends? So, in this case law, we will first observe that ICDS 5 tangible fixed assets. As per the ICDS, we will have to first determine whether it is a revenue expenditure or whether it is a capital expenditure. The expenditure on purchase of emergency spares I am talking about, whether it will be revenue in nature or capital in nature. If it is an integral part of the plant and machinery, if the emergency spares are an integral part of the plant and machinery, they should be capitalized as per ICDS by tangible fixed assets. And if they are capitalized, then the question of depreciation comes. And once capitalized, then you have to answer the question whether depreciation can be claimed on such emergency spares or not. And as we have discussed, active and passive use. If the asset has been kept ready for use, then depreciation under section 32 cannot be denied on the emergency spares. So friends, ideally, the issue under consideration could be answered in a way where if the emergency spares are capitalized in the books of accounts, if they are integral part of the plant and machinery, then they should be capitalized, and once capitalized, depreciation can be claimed on the same, based on the concept of active and passive use. On your screen, issue under consideration, allowance of depreciation on emergency spares of plant and machinery acquired during the year which even though kept ready for use have not actually been used during the relevant previous year. So friends, emergency spares kept ready for use have not been actually used. Whether depreciation will be allowed on such spares or not is the issue under consideration. High Court observed and held that as per ICDS 5 on tangible fixed assets, machinery spares shall be charged to the revenue as and when they are consumed, when such spares can be used only in connection with an item of a tangible fixed asset and their use is expected to be irregular, they shall be capitalized. So friends, ICDS 5 has been quoted by the High Court, wherein if consumed, then revenue expenditure is there. If the usage is irregular and they are integral part of a tangible fixed asset, then it shall be capitalized. Correct? When the spares are capitalized as per the above requirement, the issue as to provision of depreciation arises. Correct? Once it is capitalized, once it has been decided that the asset can be capitalized, then the issue of depreciation arises, whether depreciation can be provided on such spares which are kept ready for use, or is it necessary that they should actually be used. The court observed that the expression used for the purpose of business appearing in section 32 also takes into account emergency spares, right, which even though ready for use yet are not consumed or used during the relevant previous year. Fine. So the court has quoted section 32 wherein the expression used for the purpose of business includes active use as well as passive use. This is what has been mentioned by the court. This is because these spares are specific to a fixed asset, namely plant and machinery, and form an integral part of the fixed asset. These spares will in all probability be useless once the asset is discarded and will also have to be disposed of. Correct? In this sense, since assets are integral part of plant and machinery, in this sense, the concept of passive use which applies to standby machinery will also apply to emergency spares. So the concept which is applied to a standby equipment, example fire extinguisher, will be applicable for such emergency spares as well. Therefore, once the spares are considered as emergency spares required for plant and machinery, the SSC would be entitled to capitalize the entire cost of such spares and claim depreciation thereon. Correct? So High Court held that on emergency spares, once it has been decided that it is capitalized as per ICDS 5 tangible fixed asset, then it will be considered synonymous to a standby equipment wherein even the passive use, wherein even the asset is kept ready for use, the depreciation on such asset will be allowed to the SSC even if the asset has not actually been used, even though the asset has not been actually used, then also depreciation on such an emergency spares will be allowed to the SSC. Accordingly, Delhi High Court ruling was in favor of the SSC. SSC in this case is Insilco Limited, wherein depreciation on emergency spares, if capitalized, will be allowed as depreciation, will be allowed as deduction under section 32 of the Income Tax Act 1961. So friends, this concludes the case law. Now, the next case law, in which in examination friends, a situation will be given to you wherein you have to understand the situation and accordingly quote the relevant case law in the examination. Such type of question may also be asked to you. Correct? In such a scenario, how to take it forward will be explained by 4 case law in the subsequent slides. So friends, we have already concluded a series of case laws for the topic business and profession, profit and gains from the business or profession. We have already concluded the case law part, wherein we have discussed series of case laws. Now only 4 case laws are left, wherein we will understand if a practical situation is given to us, then how to take it forward, then how to quote a particular case law in the examination. So in the examination, you will find that after reading the problem, you know the relevant provision. However, at times, practically, there will be a difficulty in understanding the case law, in quoting the case law. Meaning, the case law is like CIT versus the name of the SSC, year, ITR reference, then which court has delivered this. So many things to remember in order to quote a case law. In the examination, if you can quote the entire case law, then very good for you. However, majority of the public won't be able to remember the entire citation of the case law. In that scenario, if you are not sure of the entire citation, then better to quote the court name, the case law, who has delivered the case law can be quoted. For example, High Court, Delhi High Court. For example, Delhi High Court has delivered the case law. So you can mention that as held by Delhi High Court in the case of CIT versus name of the assignee. This could be the citation that you can adopt for the purpose of quoting the case law in the examination. If you are not able to remember the entire citation, which believe me is very difficult, right? So remembering the entire citation, if you are quoting in the examination, you should be absolutely sure of the ITR number of the year, right? In absence of that, if you are not able to remember the citation, then you can always mention which court has delivered the case law. In our example, we took Delhi High Court in the case of CIT versus the name of the assignee. The name of the SSC will be enough for the purpose of quoting the case law. This is how you can remember the citation of the case law in the examination. So the message being, unless and until you are absolutely sure of the name of the case law, of the name of the entire citation, don't quote in the examination, don't mention it in the examination. And similarly applies to the section numbers. Unless and until you're sure of the section number, don't mention it in the examination. And trust me, it is always better to quote the section number at least. The proviso that it belongs, the explanation number, the provisos, the subsection number, clause number. It's better that you remember it, and quoting it in the examination will always fetch you some marks, right? So friends, first answer below by quoting the relevant case law. A practical scenario has been tried to be established here. I have not given an exact practical scenario, but the crux of the situation has been mentioned over here, and in examination a similar crux may be involved with broader level of practical scenario may be given in examination, wherein Mr. A, Mr. B, XYZ Limited, and with figures an example may have been given. Over here, I have tried to just mention the crux of the situation, and through which you will have to understand which case law is to be quoted. And also, these are new case laws. These are not from the case law that we have already discussed. These are the new case laws which are being quoted in this 4 case laws. Correct? Now the facts of the case. A corporation was set up by the central government, by the state government. A corporation was set up transferring all the buses owned by the state government, owned by it, for a consideration. So here, buses owned by the state government has been transferred to a corporation which is owned by a state government, and the corporation discharged the consideration by way of issuing equity shares to the state government. The corporation in its assessment claim depreciation on buses, right? Can the depreciation be denied in the corporation's hands on the ground that there was no registration of the buses in favor of the corporation? So friends, here you can understand the situation wherein the SSC is using the asset for the purpose of business or profession. However, other critical condition which needs to be satisfied for claiming depreciation is the asset should be owned by the SSC, and this criteria is not fulfilled in a way the buses are not registered in the name of the corporation, right? So in absence of registration, whether depreciation can be allowed to the SSC, to the corporation in this situation is what we have to answer. So friends, in the examination you will have to understand the situation first. You will observe that probably for the facts, if available, you would have been able to answer the question in the right way, wherein generally what we have discussed is the owner of the asset is able to claim the depreciation. However, in specific circumstances, for example, lessor and lessee, lessee has transferred, lessee is using the asset for its benefit for the purpose of business. However, there is a clause between lessor and lessee wherein if installments are not paid by lessee, then lessor has a right to take back that asset, and accordingly for this specific clause depreciation was being claimed by the lessor, because in the agreement there is a specific clause wherein the lessor has a right over the property, correct? And in absence of such a right, wherein the property has been transferred to the SSE, only the registration of the asset is pending, and accordingly as per Transfer of Property Act, where the property is being enjoyed, where the property is in possession of the lessee and he exercises right over the property in exclusion of others, meaning only he is the person who is exercising right over the property, and in such cases, in absence of, even in the absence of registration of the property in the name of the lessee, depreciation can be claimed by the lessee. So here, based on the facts, you were able to conclude whether depreciation is to be claimed by lessor or lessee. Similarly, in this situation, friends, we will have to assume that asset is being used by the corporation for the purpose of business. Asset over the asset right has been exercised by the corporation. Corporation has a right to exercise all the rights over the property, and nobody else is using the asset for its benefit. And if these terms are satisfied, wherein only the registration of the asset is pending in favor of the corporation, however, the asset is being used by the corporation full-fledged in a full-fledged manner, then depreciation can be continued to be claimed by the corporation. So based on an assumption, we can answer this question, and the case law will be, case law, how it is to be quoted in the examination is, while answering this question, you can always say that the decision of the Supreme Court in the case of Mysore Minerals Limited versus CIT. Now this reference could be an issue wherein you may not be able to, remember the year, you may not be able to remember the ITR number of the case law. In such a scenario, you can always quote that the facts of the given case are similar to the Supreme Court ruling in the case of Mysore Minerals Limited, in the case of Mysore Minerals Limited versus CIT. So facts of the case stated above, discussed above, are similar to the decision of the Supreme Court in the case of Mysore Minerals Limited versus CIT. This is what can be quoted in the examination. And what was held by the Supreme Court in this case was The term asset used in Section 32 must be assigned a wider meaning and anyone in possession of the property in its own title. So first, possession, exercising dominion over the property to the exclusion of others and having the right to use and enjoying it. So, having the right to use of the property to the exclusion of the others and in the possession of the property will be sufficient evidence that he is the owner, must be taken to be the owner of the property. So friends, Transfer of Property Act, wherein possession of the property is with the buyer and some consideration has been paid by the buyer and he is enjoying the rights on the property, he is exercising the rights on the property with exclusion of others. So he will be deemed to be owner in such situations even if the registration is not in its name. A similar concept has been adopted over here, wherein in the examination we will understand that you know the provisions as such, right? So you just need to quote it and you will just have to remember the relevant case law to it, a relevant case law to a specific situation. So what you can do is, while memorizing the provisions, while going through the provisions, you can mention the case law along with that relevant provision. For example, for depreciation, section 32, this is the relevant case law which has been discussed for a particular category, for a particular provision of section 32. So you can just mention in your notes that this is the relevant case law which was quoted, which will be used in this specific situation. And if you go specific situations wise, you will hardly find one or two case law for a specific situation in a section. So friends, the property is in the possession of the buyer of the corporation and they are using it for their benefit. Accordingly, registration of the buses is only a formality to perfect the title and does not bar the enjoyment. The corporation cannot therefore be denied depreciation on the buses. Correct? So depreciation will be allowed to the corporation. Remember the concepts of Transfer of Property Act. A similar decision was also taken in the case of CIT versus J&K Tourism Development Corporation. So another case law on the same situation. So friends, this conclude one of the case law for quoting the relevant case law in the examination for a specific situation. The second case law in this section, answer below by quoting the relevant case law. Facts of the case: son succeeded to his father's business in the year 2018. In the previous year ended 31st March 2020, son has written off the balance in the name of M, which relates to supply made by his father when he carried on the business. So, at the time of father, there was a debtor M from which funds are receivable, from which cash is receivable. However, and at the time of his father, the same entry was booked in the books of accounts, right? And in the current year, in the current previous year, son has written off the amount as bad debts not recoverable in the books of accounts. So, income was considered in the books of accounts previously when at the time of his father the income was booked in the books of accounts, and now in the current previous year the debts have been written off in the books of account as not recoverable by the son. Son desires to know whether the written off, whether such a write-off could be eligible for deduction, meaning since the business has been succeeded by the son, in such a scenario, whether provisions of section 3617 read with section 36.2 can be imposed, can be applied, wherein such written off can be allowed to be deducted in the books of accounts or not. This is what son wants to know, whether in case of succession of the business is eligible for deduction under section 36(1)(7) read with 36(2) or not. Just to give you background, 36(1)(7) is nothing but writing of bad debts as not recoverable, where one of the condition is the income first should be considered in the books of accounts, and thereafter, if that particular debt has been written off, then it will be allowed as deduction. The bad debts written off will be allowed to be deducted, will be allowed as deduction for the income tax provisions as per section 36(1)(7). So friends, we know the provisions as such, right? And we can quote the section number also. However, there will be difficulty at times in quoting the case law, right? In this case, along with the section number, make a habit to remember the relevant case law also. And the case law that you need to remember is the case laws that we have discussed in the series of case law, which are part of the topic of profit and gains from business or profession. These are the number of case law that you need to remember, right? And you can just jot down which relevant section they are discussing. So at the time of reading the provisions of that particular section, you can remember the case law name as well, the citation of the case law as well, so that will help you out at the time of answering such type of questions, correct? So the relevant provisions we know section 36(1)(7 read with section 36(2), and probably we know the answer as well, that son will be eligible for such a write-off as a deduction in the income tax law. However, what is the relevant case law in this case? The case law is Apex Court in the case of CIT versus T. Veerabhadra Rao, K. Koteshwara Rao and Company in 1995, start in 1985, held that under clause, so friends, this is the relevant case law which will have to be quoted. Under clause 7 of 36(1), the amount has been written off in the books of accounts as irrecoverable is eligible for deduction, right? Provided that that has been taken into account while computing the income of the business in the earlier previous year as per 36(2). Friends, since sales was booked previously and in the current previous year, since the amount is not recoverable, it has been written off by the son. In such a scenario, it satisfies the conditions of 36(2) and 36(1)(7). Accordingly, son is eligible for deduction in respect of the amount due in the name of M, which is written off in the books of account as bad debt, even though the debt represents the amount due from supplies made by the previous owner. So this was the crux of the situation, wherein what if the business is succeeded by son? In that scenario as well, provisions of section 36(1)(7) and 36(2) will continue to apply to the SSC, and the benefit can be taken by the SSC. The relevant case law in this case was, the facts of the case are similar to the case of Apex Court in the case of CIT versus T. Veerabhadra Rao, K. Koteshwara Rao and Company. This is what can be quoted in the examination as well. Now the third case law. We have only two case laws left, and thereafter we will be concluding the series of case law, which is part of the main topic, profit and gains from business or profession. Both these case laws are related to allowability of expenditure related to section 43B. Interest payable to GST department but not paid before the due date specified in section 139(1). So friends, as you know, in section 43B, deduction will be allowed on payment basis, and the payment should be made on or before the due date of filing of return of income. So friends, as per the provision, it can be clearly stated that this expenditure will be disallowed to the SSC, right? And there is a case law as well on this particular situation, which you will have to remember. So interest payable to GST department which is not paid before the due date would attract disallowance under section 43B. This is what the provisions also said, right? And there is an additional case law to it, Mewar Motors versus CIT, as held by Rajasthan High Court in 2003, correct? So interest, since it is not paid before the due date of filing of return of income, it won't be allowed as deduction as per section 43B. Read with case law Mewar Motors versus CIT, as held by Rajasthan High Court. Now the last one, a bank guarantee given by the company towards disputed tax liabilities, where a bank guarantee is given by the company, whether the same can be claimed as deduction as per section 43B, meaning there is a disputed tax liability and a bank guarantee is given by company. So in absence of actual payment of liability of the disputed tax liability, can an expenditure be claimed as paid as per section 43B or not is the issue under consideration. Obviously, as per the provisions, it won't be allowed since there is no actual payment made by the SSC, right? And there is a case law covering this situation as well. So for claiming deduction of any expense under section 43B, the requirement is the actual payment and not the deemed payment. So there should be actual payment and not deemed payment. Furnishing of bank guarantee cannot be equated with actual payment. Actual payment requires that money must flow from the SSC to the public exchequer as specified in section 43B. Therefore, deduction of an expense covered under section 43B cannot be claimed by merely furnishing a bank guarantee, right? Which has been covered under the case law as held by the apex court in the case of CIT versus McDowell and Company Limited. So friends, you knew the provisions. However, it's only that you need to add an additional feature, which is quoting the case law in the examination. And as discussed, this can be done when you go through the relevant provisions again. Note down the relevant case law, just the citation, just the simple citation, and this is how you will remember the case laws. So friends, we have studied around, you can say, 30 to 35 case laws in this series of case law, and this was last case law that we have studied, that we have discussed. And in the examination, quoting the case law, simple citation of the case law could be an added advantage for you. And please quote the case law only when you know the citation properly and that is applicable to the section number as well. Right? So friends, this concludes the case law series. Thank you.